So in the last class, we were studying about leases and share-based payments, right? And today we'll be discussing with revenue, and also we'll start after revenue. We'll start with the financial instruments. Okay. Now, coming to revenue, which is governed by India's 115. Now, the name of the standard has its relevance of its own. The name is revenue from contract with customers. Just see the name, revenue from contract with customers. If you understand the name properly, that itself covers the standard, the theme of the standard, you can say. Now, ideally, when someone asks us what is the meaning of revenue, we say gross receipts, right? But that's not the only meaning of revenue. When we say revenue, it means the gross receipts or the income that is arising from the ordinary activities. To give an example, let's suppose, okay, now if a company is there whose business is to sell furniture and who uses a laptop, let's suppose our organization works on teaching, right? Now, but we also use laptop, we also use camera, we also use other equipments. But the revenue, the income that we get from the teaching, the fees from the students is our revenue. But let's suppose if I sell this camera, if I sell this calculator, and the revenue which I get, the income which I get is not my revenue, because this is not my ordinary activity. This is not my normal course of business. Okay, so income which I get from the normal course of business is called as a revenue. Is it clear, everyone? The meaning of revenue. So the revenue and income are two separate things. Income is a broader picture and the revenue is one of the part of the income. Okay. Now coming to contract. So in contract, for now, understand it's a legally enforceable document. It's a legally enforceable document. What exactly is a legally enforceable document? We'll study it further in just next 5-10 minutes. Okay. But understand this contract should be a valid contract. This contract should be a valid contract. Now, what is the meaning of a valid contract is what you have to understand again, which we'll study in the subsequent part of the chapter. Now, coming to the third part of the meaning is the customers. See, understand, when I say I'm getting the revenue from the ordinary activities, who are my customers? Let's suppose that the person whom I sell this system, is he my customer? No, he is not my customer. The customer are the persons who gives us revenue. So to say it other way around, you can say any party who has entered into a contract with us to purchase the goods or services which my organization produces or manufactures or delivers in the normal course of business. Okay, so it's not that from any party if I'm getting an income, that's my customer. No. Let's suppose I'm getting a dividend income from any company, so that company is my customer. No. Let's suppose I'm getting any profit from the sale of any equipments, is that party my customer? No. So customer are the parties who intend to contract with us to purchase the goods which I manufacture in normal course of business. Okay. Now, in exchange of consideration. So that's what I have written here. Please see the screen. So parties that has contracted with the entity to obtain goods or services produced by the entity in the ordinary activities or normal course of business is the meaning of customers. So now the name says revenue from contract with the customers. Let's suppose there is no contract. Will it be covered under the standard? No. But yes, this standard definitely gives us the guidance. What if contract does not exist? In that case, how will I recognize the revenue? Okay, it gives us guidance, but that if contract is not existing, that transaction will not be covered under the standard. Okay. Now comes the applicability. See, from leases, let's suppose my business to do leases. My business is to do leases. Definitely I'll get lease income, right? But that lease income will not be covered under Ind AS 115. That will be covered under Ind AS 116. Again, for insurance contracts, not covered. Financial instruments, I'll get finance income, but that will not be covered under this one. Again comes non-monetary exchanges. What is the meaning of non-monetary exchanges? Let me explain you the meaning. Let's suppose you go to a shopkeeper, like you go to a stationery shop and you ask for a pen. Okay, a particular pen you asked. Okay, but that shopkeeper didn't have that pen. So what he'll do? He'll say that no, I don't have the pen. No, he'll say I'll get you that from the warehouse, right? But I'll tell you, he doesn't have any warehouse. What he does, he goes to the side by a shopkeeper and buys that pen and gives to the customer, right? Now, when that shopkeeper needs that pen, he comes to this shopkeeper and takes the pen. So what happens is they just exchange the similar goods or services, right? So now, will these shopkeeper, this transaction among themselves, will they record revenue? No. So this is called as an exchange of similar items, right? So these type of transactions are called as non-monetary exchanges because there is no profit intent involved here. Okay, because let's suppose I am the shopkeeper and you are the shopkeeper. Both of us know what is the actual cost of this product, right? So we'll just exchange it off. So these type of transactions will not be covered under Ind AS 115. But understand, when me as a shopkeeper, I'm selling that pen to a customer, I will definitely record revenue between them. Is that clear, everyone? So this is the applicability and the meaning of the standard. Now coming to the core principle, or you can say the theme of the standard. This theme will be helpful to you in understanding. See what happens. Earlier, like prior to Ind AS 115, in Indian regime, you used to study AS9, right? AS9 was very small, and though Ind AS 115 more or less talks in the same line, but what happens in Ind AS 115, it gives detailed guidance for each and every scenario, and it has a broader picture. Now what happens, since this world is evolving like with time, and there can be any transaction which is not covered in Ind AS 115, right? It can be so because the world is entering into in multiple transactions, and it's not practically possible for the standard setter also to cover all the transactions in a one particular standard, right? So what happens, that's the reason why the standard setter gives a particular theme that if at any point of time you get stuck, that you are not able to understand, right, how will I recognize revenue, so you have to use this core principle and move ahead and recognize the revenue for that. So the core principle says recognize revenue in an amount, and the amount should reflect the consideration that the entity will be entitled in exchange for the transferred goods or services. See, now understand what happens. There might be a case that you have paid the money in advance to the company, okay, and the company is then, and the entity is then delivering the service over a period of time. Or there can be an instance, the entity is delivering the services over a period of time, and at the end you are paying the money to the entity. In both the cases, okay, in first case you are receiving the money in the first instance, in the second case you are receiving the money after the service is being delivered. But the standard says it doesn't matter when you have received the money, whether you have received or not received, or when you will receive, doesn't matter. What matters is what is the amount you are entitled to receive for the services or the goods that you have transferred. That's the reason you should see here, consideration to which you are entitled is what matters. Consideration that you have received doesn't matter. Okay, so what matters is consideration to which you are entitled to receive. Let's suppose I have entered into contract to supply 10 units of a particular product at a price of rupees 100 per unit, and I have supplied let's suppose 3 units. So ideally, what is the amount I am entitled to receive? Tell me. 300, right? 3 units transferred, price per unit is 100. 300 is what? But what happened? Customer gives me the whole amount upfrontly. So whatever amount I have received, can I recognize it as a revenue? No, I cannot. So the excess amount which I have received will be recognized as a refund liability, and the amount which I am entitled to receive will be recognized as revenue. Okay, so that's how it happens. Now, what happens in Ind AS 115? It beautifully covers the revenue accounting in the 5 steps. Now, the 5 steps are, understand these 5 steps properly, because this is the what we have to study in Ind AS 115. This is what. Now, it says first assess whether a contract exists or not. Why? Because see the name, revenue from contract with customers. So contract should exist. So it's asked us to assess whether a contract is existing or not. And when we'll study step 1, we'll also find, it will also answer what if a contract does not exist. It will also answer the question that what if a contract does not exist. Basically, as I was mentioning, that this standard doesn't cover the transactions in which a contract is not existing. But what happens, though it doesn't cover, but it still gives us the guidance that if the agreement to which the entity and the customer is entered into does not satisfy to be a contract, how will I continue and recognize the revenue in that case? Okay. Now, second is identify performance obligation. Now, what happens is, see, definitely, assuming there is a contract, I have to identify what is my responsibility in the contract. Okay, what is my responsibility to transfer the goods or services, or goods and services to the customer. For example, let's suppose I have purchased a laptop. Okay, now me as an entity will have an obligation to deliver the laptop, to deliver the charger, to deliver the inbuilt warranty, right? So this is my obligation. But now let's suppose a customer has also asked me to give an extended warranty. So my performance obligation is to give extended warranty as well, right? So these are my performance obligations. Now step number 3 is determine transaction price. What happens? So far in step 1, first we identified there is a contract or not. In step number 2, we identified if whatever the performance obligations. Let's suppose there are 3 performance obligations in a particular contract. Assume, okay. Now it says, step 3 says, identify what is the transaction price. Identify what is the transaction price, means what is the price for overall performance obligation, not specifically for 1, 2 and 3, but overall what is the price. Okay, this is called as contract price. Now step 4 says allocate the transaction price to each of the performance obligation, meaning thereby that, see, in step number 3 we identified the transaction price for all the performance obligation as a whole. But now here what I have to do is I have to break this into specific performance obligations. Basically I have to break this transaction price for each specific performance obligation, and this is called the allocation of transaction price to each of the performance obligations. Is that clear, everyone? Now, what happens once we have allocated the transaction price to each of the performance obligations? Now the standard says, as and when the performance obligations are getting satisfied, recognize the revenue for that. So it basically what it does is it gives a step-by-step process for recognizing the revenue. Step 1 being to identify the contract. Assume in normal situations that contract exists unless the question asks you otherwise. Okay. Step 2 is identifying the performance obligation, in which case you have to identify what is my responsibilities under the contract. Okay, definitely we'll understand in detail what is the meaning of performance obligation in step number 2. Once we have identified the performance obligation, it is then we'll identify what is my transaction price as a whole, as a overall what is the transaction price, that is the contract price. Okay, that for all the performance obligation, what is the price that I have to pay. The third is I allocate this transaction price to each of the performance obligation, and as and when I satisfy performance obligation, I will continue to recognize the revenue for that. Is it clear, the steps? Let's take up an example for this one, a very basic example. Example says X Limited entered into contract with a customer for sale of software and 3-year technical support. So sale of software and 3-year technical, this is called as goods, and 3-year technical support is called as services. Very good. Now at a price of INR 30,000. Okay, so this is called as contract price, or you can say it as a transaction price. Further, software and 3-year technical support services are sold separately for INR 20,000 and INR 15,000 respectively. Now step 1, assume contract exists. Okay, step number 2, assume 2 performance obligation, that is performance obligation number 1 is sale of software and performance obligation number 2 is sale of 3 years technical support services. Now step number 3 is transaction price, that is the contract price. What is the price for the overall performance obligations? That is INR 30,000. Very good. Now coming to step number 4, allocate the transaction price to each of the performance obligation. The transaction price was 30,000. Performance obligation number 1, performance obligation number 2, and in what ratio do we divide? 2:1, basic, not 2:1, 1.5, right? So it is in the ratio of standalone selling prices, standalone selling price. So this is 30,000 multiplied by 20,000 divided by 35,000. Wonderful. And here it will be 30,000 multiplied by 15,000 divided by 35,000. So what is the amount? Can you please calculate and tell me? 17,181. 142. Okay. 17,142, and this one? Okay. Now Comes the recognition of revenue. So how will I recognize the revenue? See, let's suppose this is a 3-year period. So what I'll do is performance obligation number 1 was sale of software, which I definitely did here itself. So performance obligation number 1 got satisfied at this date itself. So hence I will recognize the revenue of 17142 here. Now 12858 gets recognized over a period of time, that is over 3 years. So what I'll do is I'll a portion over 3 years. 12858 divided by 3 comes to 4286. 4286, 4286 and 4286. Now just to give you a journal entry for the same, see on this date you have received, I'll pass the journal entry here on the date of sale. Journal entries, see in the bank I have received how much? 30,000. How much can I recognize revenue? 17,142. The rest will be treated as a refund liability. How much? 12858. Now here what I'll do, refund liability account debit to revenue. How much? 4286. Next year again 4286. Next year again 4286. So this is how I will recognize the revenue. So now understand this, again link this with the core principle. Though I have received 30,000 at the first date itself, but did I recognize 30,000 as revenue? No, because the consideration which I have received doesn't matter, but the consideration which I'm entitled to receive is what matters. Okay. Now, so this is the overall understanding of the Ind AS 115. Now what I'll do is we will be discussing the each step in detail. Is everything clear so far, everyone? Okay. Now coming to step 1, identify the contract. Okay. Now tell me, forget Ind AS 115. Forget Ind AS 115. Whenever you enter into any contract with other customer, you as a customer, okay, you get an invoice. In the invoice, what all things you will do is see. Let's suppose if you have not paid the amount, okay, first you will see whether it is approved by that party or not, and if you have approved or not, okay. Second, you will see whether the payment terms are identified or not, how you have to pay. Then you will see what is the obligation that the company has and what is your obligation, okay. So all these things, basic things you will see. Now come here, contract. So it says a contract is a legally enforceable document, and we will say, see here what I wrote here, it should be a valid contract. So now standard says it will be a valid contract if and only if all these 5 conditions are met. If all of these 5 conditions are met, if all, not 1, not 2, all, okay. First is approved by both the parties, okay. Now rights and obligations of each parties can be identified. Let's suppose, what is my right? Okay, my right is to give you classes. What is and what is your right? Your right is to receive the classes. What is my you can say obligation, or what is your obligation? So you have to identify both. What is my rights and obligations? What is your rights and obligations? Both has to be identified in the contract. Is it clear, everyone? Payment terms can be identified. So in the contract, it has to be specifically specified what is the amount to be paid, when it has to be paid, how it has to be paid. Okay, the payment terms has to be clearly specified and identified in the contract. Now, see, these 3 things are very basic level, which definitely when I enter into a contract, even I'll see. Okay, a normal person will also see. But the next 2 is what matters. The transaction should have commercial substance. Again, what is the meaning of commercial substance? Again, it should not be an exchange of similar items between the entities in the similar line of business. We just give an example for this one, right? Non-monetary exchanges. It's like that only. Okay, so the transaction should have commercial substance. Commercial substance means any transaction which has been entered with an intent to earn the profit. Okay, any transaction which has been entered with an intent to earn the profit. Now, 4th line is it is probable that the consideration will be received. Now see, I'm not saying it is that I have already received the consideration. I am saying I am probable that the consideration will be received. Let me give an example. Let's suppose I have sold a particular I have sold this calculator to one of my customer. Okay, my business is to sell the calculator. I have sold a calculator to my customer. Okay, he had not paid me the money, but he told me, Vishal, I'll pay you the money after 1 month. And I think yes, seeing his credit worthiness, I assess yes, definitely he will pay me the money. Now tell me, I have transferred the calculator to him. Definitely I'm entitled to receive the revenue, right? So I will, even if I have not received the money from the customer, I will recognize this amount as a revenue. But now let's suppose I sold this calculator to another customer, which though I felt that yes, he will pay, but after 2-3 days of sale, he got bankrupt. He became bankrupt, and I believe that he will not pay me the money. Do you think I will recognize the revenue for that party? No. See, even if I have to first, even if I recognize the revenue and I will not pay, I will have to reverse the revenue, or I will have to recognize a bad debt. Recording a revenue, recording a bad debt doesn't make sense, right? So ideally, if you have not recognized the revenue so far, do not recognize the revenue only. Okay. So it says why I'm saying like this, because the amount is not probable to be received. Amount is not probable to be received. Okay. So if the amount is not probable to be received, do not recognize the revenue for that. Why? Because it is not a valid contract. It is not a valid contract. Or I can say the revenue recognition rules will be different if it doesn't satisfy to be a contract. Now how exactly? Let's understand that. If these 5 conditions get satisfied, then I will move on to step number 2 to 5 and recognize the revenue accordingly. That is, I will assess what is my performance obligation, I will assess what is the transaction price, I will allocate the transaction price to each of the performance obligation, and then I will recognize the revenue accordingly. Okay. And if it's satisfied, I will not reassess these conditions time and again. I will not reassess, provided there is a significant change in the facts and circumstances. Let's suppose what happens on the date of sale, on the date when I sold this calculator, it was probable that the amount will be received. It was probable that the amount will be received. Okay. Going forward, okay, I will not reassess these 5 conditions again. But what happens after a period of time, that party becomes bankrupt. Okay, after a certain period of time, that party becomes bankrupt. And what happens if that party becomes bankrupt? Don't you think there is a significant change in the circumstances of facts? And if there is a significant change, then I have to reassess. And if I have to reassess, then again what happens? It will come under non-satisfied. Understood? To give you a crux of what I'm saying here is, assess these 5 conditions on the date of the contract, when the contract was entered with the customer. Okay. If it's satisfied, fine. I'll proceed to step number 2 to 5. Now, if it is not satisfied, I will come here. Okay. Now, what I'll do is I will reassess on every reporting date, that if it gets satisfied or not. Okay. I will keep on reassessing it every reporting date. And let's suppose I have received any advance from any customer. Okay. To give an example, I entered into a contract for sale of any property. Okay. And the property was worth 1 crore rupees. And the customer has paid me 5% as an advance. Okay. Let's suppose 5 lakh is given as an advance. Okay. Now, I am not probable to receive the remaining 95 lakhs. So if I am not probable to receive the consideration, it will not be satisfied. These 5 conditions are not satisfied. It is not a valid contract. Okay, so I will continue to reassess these conditions on every reporting date. But what about the advance of 5 lakh that I have received? What about that advance? So standard says, if you have received any advance from the customer, then what you have to do is, you can recognize that advance as revenue in either of the circumstances. First, you have transferred all the goods or services, and the advance which you have received forms substantial part of the transaction price. Okay, and that amount is non-refundable. See, all the goods and services are transferred. First point, substantial consideration is received, and the amount is non-refundable. In our case, is 5 lakh a substantial consideration? No. Then come to this part. Contract is terminated and the amount is non-refundable. Okay. So see, if I am probable that the party will not pay me the consideration. Okay. But he has not terminated the contract also. So till the time he has not terminated the contract, I will continue to recognize that 5 lakh as refund liability. I can recognize that 5 lakh as a revenue only if, first case, the contract gets terminated and the amount is not refundable. Second case, the top 5 condition, get satisfied, and I receive the further consideration, and I deliver the goods or services, and then I can recognize the revenue. Is that clear, everyone? So just giving you a brief crux of it. Understand, on the date when I enter into transaction with a customer, I will assess these 5 conditions. If it gets satisfied, fine, I will move to step number 2 to 5. If it doesn't get satisfied, then I will what I will do in that case is I will reassess on every reporting dates. I will reassess these 5 conditions on every reporting dates. If it gets satisfied, fine. If it not get satisfied and I have received any advance, then at that advance I can recognize as a revenue if the contract is terminated and the amount is non-refundable. Okay, so that's what it says. Is that clear, step 1 so far? Now coming on to combining contracts, not that relevant from an exam perspective, but yes, let's understand that. 2 or more contracts. Let's suppose what happens with the same customer, I have entered two contracts. One contract is for the sale of the calculator, another contract is for the sale of this book, another contract is for the sale of this mouse. Okay, so 3 contracts have entered with a customer. It says that if there are 2 or more contracts that are entered into at or near same time with the same customer, then I have to merge all the contracts. I have to combine all the contracts and make it one, account for it as one contract. If any of these, understand the word any of these is satisfied, I have negotiated as a single commercial objective. Basically, this calculator, this book, and this mouse is dependent on each other. Single commercial objective. Okay, but is it happening in this case? No, they are separate. Okay, not satisfied. Consideration of one contract depends on the price or performance of another contract. Let's suppose, to give an example, I have purchased one flat from a builder, okay, as a customer, okay, for 1 crore, and when I go to purchase for another flat, I say to the entity that, see, I have already purchased 1 flat, so please give me a discount on another, right? So what happens? The price of the another contract is dependent on the performance of the previous contract, right? So they are dependent, though there are 2 contracts, but the performance is dependent, or the price is dependent on each other, right? So again, in this case also I can merge. The third is goods or services are promised as a single performance obligation. So it says if any of these 3 gets satisfied, we will merge all the contracts and account for it as one contract. Okay. You will see an example in your book for water purifying plant. You'll see an example in a book for a water purifying plant, in which what happens, entity enters into contract, separate contract for construction, separate contract for designing, separate contract for you can say water purifying. There are 3 contracts, but they are negotiated as a single commercial objective, because definitely the customer will not get benefited only from the construction, or only from the designing, or only from the water purifying. So they have to be merged and made one. So that is one performance obligation. So even though there are 3 contracts, but we'll account for them as one contract. Okay. Just a minute. Now, so the next point which you have to study is step number 2. Is determining the performance obligation, right? So step number 2 is determining performance obligation. Now, what is the meaning of a performance obligation? So if you have to answer in a layman terms, we say performance obligations are the promises which an entity makes to the customer, right? But the promises which are distinct. Now, what is the meaning of a distinct promises? Understand, let me write here. The promises which are distinct. Let me take up an example and then explain it of you. Let's suppose this is the entity and this is the customer. Entity enters into contract with the customer for sale of laptop. Okay, and in the laptop it will sell the laptop plus inbuilt warranty, okay. Now, so these are the 2 promises, promise number 1, promise number 2. So can I say that the laptop and inbuilt warranty, they are two separate performance obligations? No, I cannot say that. Why? Because standard says that the each promises in the contract which are distinct is called a performance obligation. Now comes the question, how will I assess whether a promise is distinct or not? For that, the standard gives you two conditions, right? The two conditions are, first condition is the customer can benefit on its own or with other resources readily available with the customer, right? Now, and the second condition is the promises are separately identifiable in relation to other promises in the contract. Now understand here. Let me write the two conditions. Condition number 1, condition number 2. Condition number 1 is customer can benefit on its own or with other resources, okay, readily available with the customer. And condition number 2 is separately identifiable. Now what happens here, entity says the meaning of the first condition, that the customer can benefit on its own, means customer can purchase it separately. If the customer can purchase the goods or services separately, it means the customer can use those goods, a customer can benefit from those goods or services separately. And what is the meaning of condition number 2, separately identifiable? The entity says that if the customer can use it separately, see, condition number 1 means purchase it separately. Condition number 2 means use it separately. Means if from a promise that the entity makes to the customer can purchase and use separately each of the promises, then they are distinct, otherwise they are not distinct. Okay, so the two things which you have to focus here is purchase and use. Now let's assess from this one. Let's suppose you go to purchase a laptop. Think from the point of view of customer. You go to purchase a laptop. Will you purchase it without inbuilt warranty? Ideally, no. Okay. Now, can you purchase inbuilt warranty separately? No. Right. So, meaning thereby the laptop and the inbuilt warranty are dependent on each other. Right. We cannot purchase it separately or we cannot use it separately. Now, understand. So, what happens if we find a promise dependent on another promise that is not distinct? So what I do is I'll make a bundle of it. And till when I'll make a bundle? Continue to make a bundle till the time it becomes separate, till the time it becomes distinct. Now coming to laptop plus inbuilt warranty. Now if I have purchased laptop plus inbuilt warranty, can I purchase this laptop plus inbuilt warranty separately? Yes. Can I purchase laptop plus inbuilt warranty separately and can I use it separately also? Yes, I can use it separately also. Now coming to another example. I have purchased a laptop plus I have also taken an extended warranty. Now, so in the laptop, I will definitely take laptop plus inbuilt warranty. I'll write here like this. Promise number 1, promise number 2, promise number 3. Promise number 1 is laptop. Promise number 2 is inbuilt warranty, which is also called as the standard warranty for 1 year, which I get along with the product. And the third one is extended warranty. As we saw right now that the laptop plus inbuilt warranty are dependent on each other. But now let's evaluate for extended warranty. Can you purchase extended warranty separately? Yes. Can we use it separately? Yes. So this is again a distinct. This is again a distinct. So what happens? Even though there are 3 promises in the contract, but that gives us 2 performance obligation. Performance obligation number 1 and performance obligation number 2. So this is what is the meaning of performance obligation. So whenever we have to assess what is the performance obligation in the contract, we have to assess few things is whether the promise made in the contract is distinct or not. Okay, if it is not distinct, I have to make a bundle of those goods or services. Okay, if it is not distinct, I have to make a bundle and make it distinct, and that distinct promise will be called as performance obligation. Now understand again, in a particular contract there can be two instances. First instance is there is one promise only. If there is only one promise, definitely that will be distinct, right? Assuming contract to sell this calculator, one promise to sell this calculator, there is no warranty, nothing. Okay, this is what is the standard practice of the market. So this is a one promise, this is a you can say a separate performance obligation. But now let's suppose in this case there are multiple promises in a contract. Now if there are multiple promises in a contract, in that case I will have to identify whether the promises are distinct or not. If they are not distinct, I will continue to make a bundle. Let's suppose there are four promises. I assess this promise, this is not distinct, this is linked with this one, so I will make a bundle. Okay, now again these two are also not distinct, they are linked with this one, so now again I will make a bundle. Okay, now these three are become a distinct, so this will become one performance obligation and this will become one performance obligation. Okay, so what I have to do is I have to continue to make a bundle of promises till the time it becomes distinct. Is that clear, everyone? So that's our step number 2. Now moving on to step number 3. Is there any example which I have to take? Okay, one example that I have to take here is in step number 2. When I was taking this example of condition number 2, separately identifiable, the standard says that how will I say that it will be separate? How will I identify separately identifiability in the exam? Okay, so standard says 3 things: significant, integration, or customization, or modification. Now standard says that to identify separately identifiability in the separately identifiability, you will have to assess. Let's suppose there are 3 performance obligation and this performance obligation is significantly integrated with this one. Okay, let's suppose I have sold a software and I have sold the technical updates for 3 years. Okay, and the updates has to be taken from me only. Okay, you cannot take the updates from someone else in the market. Can I purchase it separately? No, right? So this is significantly integrated. So in that case, it is not separately identifiable and the condition number 2 fails. Or significant customization or significant modification is involved. Okay, so it says if either of them is there, we'll say that the promises are not separately identifiable. Is that clear, everyone? Okay, so now another one more thing is condition number 1 and condition number 2 both has to be satisfied here. Okay, means the promises has to be distinct on its own and in relation to other promises in the contract. Okay, so there is a word called and here, don't forget this, there is a word called and here. Okay, now coming to step number 3. What is step number 3? Can you please name it? Name of step number 3? Transaction price. So it is called as determine transaction price. Now understand guys, transaction price can be fixed, can be variable. Fixed is very sorted. Let's suppose I have entered into a contract with a customer for sale of any particular product, and I will receive rupees 100 or rupees 1000, whatever it is. Okay, so that's called fixed. Okay, so I don't believe there is any challenge in the fixed. Coming to variable consideration, the question that comes up now is, will I consider variable consideration as part of my transaction price? Is the question. But before that, let's understand what is the meaning of variable consideration. I'll say that whenever the amount which I have to receive in the future is not certain, that is called as a variable consideration. Or the amount which I have to receive in the future is certain, the amount which I have to receive in the future is certain, but whether I receive it or not is not certain. Again, it's variable. Okay, so the if I have a right or to receive or not is uncertain, again it becomes variable. If the right is certain, but what is the amount that I'll get is uncertain, again it becomes variable. Okay, or if there is a component of, you can say, rewards, penalty, discount. Okay, all these again make it variable. To give an example, what happens in a real estate contracts? Let's suppose I enter into a contract. I'm a company, I'm an entity. I enter into contract to build a hospital. Okay, for within 2 years, and the contract price is 100 crores. The 100 crores become the fixed transaction price. But what happens? The customer says to me that, Vishal, if you deliver this building, this hospital within 1 year itself, though you have told me to complete within 3 years, but if you complete within 1 year, I will give you a reward of 10 lakhs. Okay. If you complete within 2 years, I will give you a reward of 20 lakhs, or sorry, 5 lakhs. Okay. But if you complete beyond 3 years, I will charge you a penalty of 2 lakhs. Okay. Now here what happens? My right to receive is certain, but which one? I don't know. Okay. So the amount becomes variable here. Further, that particular customer itself says me, Vishal, if I like the quality of building which you have constructed, I'll pay you 10 lakhs. Okay. But if I don't like, I will not pay you anything. Amount is certain here, but whether I'll receive it or not is not certain here. Okay. So all these things makes a consideration as variable. Now, so after understanding what is the meaning of a variable consideration, the next question which comes up is, will we include the variable consideration in the transaction price or not? To answer that, standard says it's an estimate. Standard says that it's an estimate. Now, standard says that definitely you can include the variable consideration as part of your transaction price, provided you are reasonably certain that whatever amount you are including in your transaction price, you are not going to reverse in the future. Okay, you are not going to reverse in the future. Meaning thereby, see, that makes very much sense also. Basically says that you can consider variable consideration as part of your transaction price, but since it is an estimate, so apply your judgment and recognize variable consideration as part of transaction price only if you are very much sure, you are very much certain that you will not reverse in the future. Okay. But when the standard says this, that you will not reverse in the future, is that mean that I am not allowed to reverse in the future? No, I can reverse, because that's an estimate, it can change, right? But it says that assessing the today's estimates, based on today's estimates, you are certain that you will not reverse in the future. But yes, if in the future the estimate changes, yes, you can reverse that. Okay, so that's what the standard says. Now, we have answered few things here. We have answered what is the meaning of variable consideration. We have answered in what situation will we include variable consideration as part of the transaction price. The third question that comes up now is, if at all we have to include the variable consideration as part of the transaction price, how will I measure that? Okay, is that clear, everyone? Meaning clear, and when we have to include, is that clear? And now we have to understand how to measure a variable consideration. Measurement of variable consideration. Standard gives you two formulas for that. One is expected value method. Another is most likely method. Very good. Now, tell me, when will we use expected value method? When there is a range of possible outcomes, meaning thereby, okay, meaning thereby, it can happen this way also, 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 right? So I do have a range of possible outcomes. Okay, in that case, I take expected value method. And what is the meaning of expected value method? I will say if there are 4 outcomes A, B, C, D. In outcome number A, I will get 10 million. In outcome number B, I'll get 12 million. In outcome number C, I'll get 8 million. In outcome number D, I'll get 9 million. The probability is 20% for this one. The probability is you can say 30% in this one. The probability is 45% of this one. The probability is 5% of this one. Now measure the 20% is 2 million, 3.6 million. This one is 3.6 million again, and this one is 9 into 0.45 million. So what is the amount? 2 plus 3.6 plus 3.6 plus 0.45 comes to a 9.65 million. So this 9.65 is the expected value of variable consideration, which has to be recognized as a revenue. Now, what is the meaning of most likely method? Meaning thereby, whenever there is a only 2 possible outcomes, and out of 2 possible outcomes, we'll see which is the most likely outcome. Let's suppose 2 possible outcomes. Either I will get 10 crores as a incentive, or I'll get 0 amount. Okay. Now I have to say quality bonus. The answer example for it, quality bonus. If I like the quality, I will give you 10 crore. If I don't like the quality, I will not give you even a single penny for that. Okay. Now the probability for this is 75%. The probability for this is 25%. So this becomes the most likely amount. Is that clear, everyone? Now, so comes a question on this one, on variable consideration. Let's try to solve this question, all of you. Variable consideration has been a favorite topic of the examiner. So please solve it diligently. A very easy question. No much challenge in this one. Please try to solve this question, giving 5 minutes time. It says AST Limited enters into a contract with a customer to build a manufacturing facility. The entity determines that the contract contains one performance obligation satisfied over a period of time. Okay, so now whenever there is an over a period of time, I have to measure what? Measure of progress. Now it says the construction is scheduled to be completed by the end of the 36th month for an agreed upon price of rupees 25 crores. This is a fixed consideration. Okay, now the entity also has the opportunity to earn a performance bonus for the early completion as follows. It says I will get 15% bonus. Okay, I'll write the tabular format. Bonus percentage amount. Bonus, I'll get 15% bonus if the contract is completed by 30th of the month. Okay, see, ideally it says that you have to complete the project within 36th month. Okay, but if you complete by 30th month, then you will get 15% bonus. 15% bonus amounts to how much? 25 crores into 15% comes to 3.75. Okay, now what is the probability for this one? 25%. Now again 10% bonus I will get means 2.5 crores. The probability is 40%. Third is I will get 5% bonus if I complete by 34th month. That is 1 point. The probability is 15%. Now, so what is the amount? This one, just a minute. 3.7 25. Just give me a minute. Just from calculating, 0.5 is 1.25. Okay, now it's 1.25. Sorry. Now, so what is the sum of the probability? 25 plus 40 plus 15 is 80. Now, again, there is a 20% probability that I will get nothing, right? Because the sum of the probability should be 0, right? Now, tell me which method shall I apply? Most likely method or expected value method? Why? Because there is a range of possible outcomes. Okay, now can you please calculate the probability weighted figure amount? Expected value method? Yes. Okay, you final figure you tell me? 2.125 crores, right? Now again, see the next part. In addition to that, in addition to the potential performance bonus for early completion, see this is a performance bonus. Okay, this is performance bonus. Okay, now AST Limited is also entitled to a quality bonus. Let me write here. Now what happens in a quality bonus? Quality bonus of 2 crores. If a health and safety inspector assigns of the facility a gold star rating as defined by the agency in the terms of the contract, okay, it says that if the inspector approves it, you will get 2 crores, otherwise you will not get this 2 crores. AST Limited concludes that it is 60% likely that it will receive the quality bonus. 60% likely means what? It is most likely that I will receive it. It is most likely that I will receive it. Now, what is the question? Determine the transaction price. Now, tell me. Transaction price. What was the fixed transaction price? 25 crores. This is fixed. Now, what is the expected value method? Transaction price variable, that is 2.125. This is variable. Now, again, 2 crores. Right? This is also variable consideration. Right? That is most likely method. So, what is the total transaction price? Can you please? 29.125 crores. Is that clear, everyone? Good. Now, one more example. One more question. Please try to solve this one. This question covers two concepts. One is the concept on variable consideration and another is a concept on cumulative catch-up method. Okay. Though we have not discussed the cumulative catch-up method, but I think you can solve this question also. After that, I'll discuss that. Please try to solve this question, guys. A very easy question, but yes, an important one. Giving you 2 minutes time to read the question. After that, I'll explain the question and then we'll solve it. Done? Okay, let's try to read the question and understand the question. It says that entity has a fixed fee contract for INR 1 million, okay, which is a fixed transaction price, to develop a product that meets specified performance criteria. The estimated cost to complete the contract is 9.5 lakhs. So it says the transaction price is 10 lakhs and the cost to complete the project is 9.5 lakhs. So overall profit will be 50,000. Very good. Now, the entity will transfer the control of the product over 5 years. Now, if the control will be transferred over 5 years, means it is satisfied over a period of time. So, we will measure the progress and recognize revenue over a period of time, right? Now, it says the entity uses cost to cost input method, to measure the progress, means you will use input method to measure the progress of, okay. Now, an incentive method. Now, see, this was fixed, now comes variable. It says if the weight of the product is 951 kgs or greater, I will not get any incentive. If it is 701 kgs to 950 kgs, I'll get 10% incentive, and 10% of 10 lakhs comes to 1 lakh. If it is 700 or less, I'll get 25% incentive, and 25% of 10 lakhs comes to 2.5 lakhs. Okay. Now, so this is the incentive which I'll get. But there is a range of possible outcomes, A, B, or C, right? But now read this paragraph. What does it say? The entity has an extensive experience creating products that meet the specific performance criteria. Basically, it says the entity has a very vast experience in making these products. Okay. Now, on the basis of that experience, entity says that based on its experience, entity has identified 5 engineering alternatives that will achieve the 10% incentive. It says that entity has identified 5 alternatives that will definitely achieve this 10% criterion. Okay. And just a minute. And entities also identified 2 engineering alternatives that will achieve 25% criterion. Okay. Now, standard entity again says that in this case, entity determine that there is a 95% confidence. There is a 95% confidence that it will achieve 10% incentive. Right here, there is a 95% confidence here, and there is a 20% confidence here. Now tell me, which method will you apply? Most likely method or expected value method? Most likely. Why? Because this amount is most likely 95% confidence, right? Now, so we will take this amount. We'll take this amount by using most likely method. Clear till here, everyone? Now, based on the analysis, entity believes the 10% to be the most likely amount when estimating the transaction price. We already assessed that. Therefore, the entity includes only the 10% award in the transaction price when calculating revenue, because the entity has concluded it is probable that the uncertainty associated with the variable consideration is subsequently resolved due to its 95% confidence. Okay, there is just giving story now. Now, let's assess year. 1, 2, 3, 4 and 5. Percentage of completion. Now, tell me, what is the percentage of completion for these 5 years? Cost to cost method, input method. So can you please, so 50,000 by 950,000, tell me. 5 point, so 26%. Second year, 18.43. Okay, 18.42%. Third year, 42.11%. Fourth year, 28.95. Fifth year, 5.26%. Now, can you tell me cumulative? Okay, let's let it be. Now, tell me the amount of revenue to be recognized. Amount of revenue to be recognized. Tell me, 10 lakhs plus 1 lakh variable consideration, right? Multiplied by 5.26 percentage is how much? No, this is lakhs. Can you please tell me the figures in absolute figures? 11 lakhs multiplied by 526, 57,860. Now same thing here also you do. 11 lakhs multiplied by 18.42 percentage. 2 lakh 20,000. Okay. 202,620. Third year 11 lakh multiplied by 42.11 percentage is how much? 4 lakh 60 to 10. Now fourth year 28.95. Just a minute. 28.95. How much? How come 4 lakh? It will be 456. 50. Now let's stop here. Let's read the last paragraph now. The entity reassesses its production status quarterly to determine whether it is on track to meet the criteria for the incentive award. Now understand, this variable consideration was an estimate, right? And on the date of the contract, we found it reasonably certain to recognize 1 lakh as the variable consideration in the transaction price. But now it's an estimate. We'll definitely reassess the estimates and every reporting dates, but the entity assesses on every quarterly. That's fine. So it says that at the end of fourth year, at the end of the year 4, it becomes apparent that the contract will fully include the entire 25% incentive in the year 4 as because at this point it is probable that the significant reversal in the amount of cumulative revenue recognized will not occur when including the entire variable consideration in the transaction price. Now it says that my estimate has changed. Now I think 25% can be recognized as a revenue. Now tell me, so far how much we have recognized? 1 lakh, right? But now it says that we can recognize 2,50,000. But now understand, if we take 2,50,000, what is the amount of cumulative revenue to be recognized till date? Allow me a moment, please. Cumulative revenue to be recognized till end of year 4 if 2.5 lakh was considered. So what we would have taken 10 lakh plus 2.5 lakh multiplied by, can you please add all these things? Percentage? So not this, all this one, this one. 94.74 percentage. What is the amount? Tell me. 11,84,250. Okay, so this is the amount of revenue that should ideally have been recognized if we have considered 2.5 lakh from initially, right? But now tell me, can you please add these four, and tell me what is the amount of revenue that I have recognized? Revenue already recognized. Tell me the amount. 1042 140. Now can you please find the difference between them? 1,42,130. 110. Now this is called as cumulative catch-up adjustment. This is called as cumulative catch-up adjustment. So basically what you have done here is you have recognized 150,000 multiplied by 0.9474 is what you have recognized as a revenue. So basically, see, understand, For variable consideration, we recognized 1 lakh in year 1, year 2, year 3, year 4 proportionately, right? But we are saying that the estimate has changed from 1 to 2.5, right? So what is the additional 1.5? So for this 1.5, and what is the percentage of completion? 94.74. Please enter in a calculator 1,50,000 multiplied by 94.74 percentage, and that's the amount that is there, right? So this is the called as cumulative catch-up adjustment. Is it clear now? Okay. Now in the exam, question can come in two forms. Okay. You should write this in your notebook as well. In the exam, question can come in two formats. First, calculate the amount of revenue to be recognized in year 4. Second type of question, calculate the amount of adjustment due to change of estimate. So for this you will write what? You will write how much? 142,110. Clear everyone? For this what you will write? What is the amount? Already 318,450, right? So here you write 318,450 plus 142,110. What is the amount? 318,450 plus 318,450 460,560. So this is what should be the answer. Now the question can come in any format in the exam, okay? But you should be ready for both the format. Is that clear, everyone? Anyone having any queries in this example till here? Yes, please. Yes. See, non-monetary exchanges is different thing, right? Barter is different. Barter can be, I am giving you this calculator and I am taking something different from you, right? Non-monetary means I am giving you calculator, I will take calculator. Okay? Pardon? Right? No, see what I am saying, but non-monetary is also a form of barter, but barter is a very broader term. Okay? Barter is a very broader term. Understand it properly. Though we will consider that in this class also. Barter means I am giving you non-cash consideration. Okay, I am not giving you in cash. Rather, I am settling the consideration in the form of non-cash. Okay, or might be in kind. Okay, that is called as barter, exchange of assets. Okay, but non-monetary exchange means exchange of similar assets. Okay, barter is covered here, but non-monetary is not covered here. Okay, barter is covered, but non-monetary is not covered. Because barter means what? Let's suppose you purchase classes from me, okay, and you say that, sir, I will not pay your fees in cash, but I will give you in the form of laptop or in the form of any furniture. That is covered here. But if you say that, sir, you give me this calculator, I will give you another calculator, the same calculator, the same lives, everything, that is not covered here. Understood? Pardon? Barter we'll discuss in the class. Okay, don't worry, we'll discuss. That is already covered. Pardon? Right. In oral conditions, you are saying. Okay, so it says that the 5 conditions or the contract should not be in writing only. It can be as per the customary business practices. Okay, so let's suppose you went to a shop and for purchasing anything, the discussions which you have, that is a contract. Let's suppose you board a flight, the flight ticket which you get, the boarding pass which you get, okay, that's a contract. So basically the contract will differ from business to business. That's the reason when you read the standard, it's clearly written here, the contract need not be in writing only. It can be in writing, it can be orally, it can be as per any other customary business practices, because multiple businesses will have different type of contracts. Okay, if you enter into a lease contract, the contract will be of 5 to 6 pages, right? If you enter into just a shop, when you purchase something from the shopkeeper, it will just be an invoice which you get, that is a contract. Okay, so might be a case you're not getting the invoice also, but that discussions which you are having orally, that is a contract. See, generally we understand or we assume that it is satisfied. Okay, from an exam perspective, only one thing will matter: the fifth condition, that is probability of receiving the consideration. Rest all you have to assume that it is satisfied. Okay, now if you talk from a practical perspective, yes, we have to assess from a different perspective. Okay, and let's suppose I am doing a business where my contract, where everything is written in the contract, particular contract. Definitely, I can assess that. But something is orally happening orally. Okay, then I have to assess from a point of view of business whether this business, the contract is happening orally. So all these conditions are getting satisfied or not on an overall level. I will see. Okay. Now see the cumulative catch-up method. It says that entity will reassess. An entity will reassess the estimates of variable consideration at the end of each reporting period. If there is any change in such estimates, then it should account for as a cumulative catch-up method. And what is the meaning of cumulative catch-up method? Is amount of revenue as per the revised estimates 1184250 as per the revised estimates minus amount of revenue already recognized 1042140. This is called as the adjustment to revenue, which is called as cumulative catch-up adjustment. And just to show you one thing here, see how many times cumulative catch-up adjustment has come in the exam. Cumulative catch-up, again one more cumulative catch-up, right? So this is how it is very important. Okay, is that clear, everyone? Now this question is tested in the November 2020 2A for 14 marks. Again, it deals with the cumulative catch-up and also with the variable consideration. Similar type of question which I think you can solve as an assignment. Okay, not taking up this question in the class, but you can solve it as an assignment. Just a minute. Okay. Now just one more page. I think there's a challenge in this page as well, but no worries. I'll take it from here. The next topic in transaction price, guys, come on, attention here. So far in revenue, we studied the meaning of revenue, we studied the core principle, we studied the overall five steps. Then we studied step number 1. We told that there can be 5 conditions in step 1, that is approved by both the parties: rights and obligations, payment terms, commercial substance, and probability of receiving the consideration. If it is satisfied, then we will move on to step number 2 to 5. If it is not satisfied, then I will reassess on each reporting dates. And then again, what happens if I have received any advance? Then I will see whether I have transferred all the goods services, received the amount whole of the consideration, and the amount which I have received is not refundable, then I can recognize the revenue. If not, then whatever amount I have received, the contract is terminated and the amount is not refundable, then I can recognize the revenue. That's step number 1. Coming to step number 2, I said performance obligations. Whatever promises are distinct, they are performance obligations. If there are multiple promises in a contract, I have to identify which are distinct. If they are not distinct, I will make a bundle and make them distinct. Okay. Coming to step number 3, I told the transaction price can be fixed, can be variable. If it is fixed, fine. If it is variable, I have to estimate it. Okay. Now I have to assess whether this variable concession can be included or not. Okay, based on my you can say judgment. If it has to be included, it can be measured using 2 methods. Expected value method, then comes most likely method. Okay. Then we took up an example on that. Then also we studied cumulative catch-up adjustment, which is we will calculate the amount of revenue to be recognized as per the revised estimates. Then we'll also assess what is the revenue already recognized. Then we'll come to an adjustment, that is what is the revenue to be recognized, which is called as cumulative catch-up adjustment. So these are the 3 steps that we've studied. Now in the third step, that is transaction price, we have to study the next concept is significant financing component. I don't know how, but this few pages has gone off in this notebook. Don't worry. but we'll manage it somehow. Significant financing component. Guys, understand the meaning of significant financing component, and I can guarantee that all of you at some point or the other have entered into this transaction which has significant financing component. Ever purchased on anything on EMI? Right? Almost all of you have purchased, right? You know, when you purchase anything on EMI, the entity gives you a benefit of finance to you, right? Entity gives a benefit of finance, and that's a significant financing component. That includes a significant financing component. Okay. Now, it's not always the entity giving the benefit of finance. It can be the case that the customer gives a benefit of finance to the entity. How exactly? Entity says, customer says that whatever is the price of the goods, you take it from me now, you manufacture the goods and deliver it to me after 2 years. So now what is happening here is the customer is giving the money to the entity well in advance, right? So the customer gives the benefit of finance to the entity. Okay, it can be both way around. It can be both way around. Understand? When there is a time gap, whenever there is a time gap between transfer, whenever there is a time gap between transfer of control of goods or services between consideration received there is a time gap, there is a time gap, and this time gap is greater than 12 months, then we say that there is a significant financing component involved. Now, it can be the case that the consideration is received now, I will deliver the goods after 2 years. It can be the case that I am transferred the goods now, but I will receive the consideration after 1 year or 2 years or 3 years might be the case. Okay, so both of the cases will have a benefit of financing to either of the parties. Now comes the question, if there is a benefit of finance, either to the entity or to the customer, how will I recognize the revenue? One simple rule you write off: revenue will be equals to value of consideration on the date when control of goods or services are transferred. If you remember this line, significant financing component concept will become quite easier for you. I'll prove this also, don't worry. Let me take two cases. Case A. Control is transferred here, consideration is received here. This is year end 1, year end 2, that is time gap of 2 years I am keeping. Okay, I have received a consideration of, let's suppose, 100,000. Okay, the discounting rate I will assume in this case at the rate of 10%. Tell me, when I have transferred the control here, but I have received the consideration here. Question is first question, when will I have to recognize revenue? When will I recognize revenue? I am writing 3 points here. Okay, just tell me which point, A, B or C? A. So I have to recognize the revenue here, but I will receive the consideration here. Now read this line: value of consideration, value of this consideration on the date when the control is transferred. So what is the value of this on this date? It is called as present value. So your revenue will be equals to the present value at the, what is the amount? Can you please tell me? 82,000? 640, right? Yeah. So now this is the amount of revenue, but did you receive the amount? No. What you will write? Contract asset or trade receivable to, you can say, revenue 82640, right? Now what will you do over the 2 years? You will unwind it again and record interest income, or we call it as a finance income, right? So you'll write again contract asset or trade receivables, whatever it is, to finance income. What is the amount? 8264. So what is that balance of contract asset? It becomes 82640 plus 8264. It becomes how much? 82640 plus 82690,904. Now again in this year also you will record 9090, right? So what is the balance of contract asset now? 90904 plus 9090, approximately 100,000, right? Now pardon, now what you will do here is you will recover this one now. So how will you recover? You will recover it bank account debit to contract asset is how much? 100,000. Is it clear, everyone? So this is how you will settle this transaction. Now let me take up one more case. Wherein the control gets transferred here and consideration is received here. Okay. Now tell me, year end 1, year end 2, point number A, B or C. Tell me, where will I recognize revenue? C. So I will definitely recognize the revenue here. But I have received the consideration here itself. What will I do with that? Control is not transferred, so it will be liability. So definitely I'll do bank account debit to liability 1 lakh, right? Now what I'll do? Again I will calculate the future value here. So what I'll do, I'll record finance costs. Finance cost account debit to liability again. How much? 10,000. Not 10 lakhs, 10,000. Sorry. It will be 10,000. Now again I will record the finance cost here as well. So it will be finance costs account debit to liability. How much? 1 lakh plus 10,000 is 1,10,000. Multiplied 10% is 11,000. So how much does it become? 1,21,000. So I will recognize the revenue of how much? 1,21,000 is the amount of revenue which I will recognize. Is that clear, everyone? So basically, always remember this line: value of consideration on the date when the control is transferred. See here, I calculate the present value. Here, I calculate the future value. That's the only thing. Is that clear, everyone? Now, there are certain cases, okay, wherein it will appear as if it is a case of significant financing component, but these 3 cases are specifically not a case of significant financing component. Now, what has happened? Customer has paid for the goods, okay, in advance, but has not collected the goods. Customer has paid the goods, but has not collected the goods. Customer has paid, but not collected. Now you will see, oh sir, customer has paid, but not collected. There is a timing gap. There should be a SFC. But understand, reason. The timing of transfer of those goods or services is at the discretion of the customer and not the entity. Now, here, if I do written here entity, it would have been a case of significant financing component, right? But here, since it is customer, means the goods are ready with me. It's the customer who has not collected it off, right? So it is not a case of significant financing component. Clear, everyone? Second is consideration is variable, means you can say sales based or usage based royalty, right? So wherein the amount will be received in the future, because the consideration is variable and we don't know what is the amount to be transferred. Okay, now the difference between contracted price and the cash selling price is there is difference, and the reason is other than financing, that is high credit risk. I'll tell you what happens. Let's suppose Reliance sells products to India for 100 rupees, but if the Reliance will sell the same product in Nigeria, it will sell for 120. Why? Because Reliance feels that there is a significant credit risk involved. Okay, so might be the case that I'll not recover the money, so I'll charge higher amount. So even if I don't receive the money, partial money, I will recover the cost at least. Okay, so that's the reason there is a difference between the contracted price and the cash selling price. Is that clear, everyone? So it says this in these three cases, it will not be a case of significant financing component. Now, non-cash consideration, your query will come here. Okay. Now what is happening? Entity, just a minute, is transferring the promised goods or services, and entity is receiving the consideration. Now this is consideration is in non-cash. Now this is a sort of barter transaction. But assume, forget this barter word for now, forget this barter word. Tell me, I am an entity, you are customers. Okay, I transferred you this calculator. Okay, and the price of this calculator ideally was 400, but I told, since you guys are my customer, already my students, so you can pay me 300 only. Tell me what is the amount of revenue I will recognize, 300 or 400? The price of this calculator is 400, but I told that since you guys are my students, I am giving you a discount of 100. You give me only 300. What is the revenue that I will recognize? 300, right? Now, another thing, I am telling you, I am giving you this calculator, okay? But for that, you are giving me some other thing, might be another asset that you are having, okay? Now tell me, the price of this calculator is 400, price of the goods that you are giving me is 350. What is the amount of revenue that I should record? Okay. Why you are doing partiality in the case of cash and non-cash? The price of the calculator was in both the cases, when you paid cash or even when you are doing non-cash, in both the cases the price of the calculator was 400 only. When you gave me cash, you gave me 300. When you are giving me non-cash, you are giving me goods worth 350. So why are you telling in one case 300 and in one case 400? Why? I am writing this case so that you will understand it better. Okay. Analyze this case. Analyze this case. Case A. This is myself. This is you. I gave you calculator. I am entity. Okay. This calculator is fair value is 400. Okay. You gave me cash of 300. So you are saying that, sir, you should recognize the revenue of 300. Very good. Now another situation, case B. Again, myself, I am gave you a calculator, the fair value of which is 400. This is you. Okay. Now what you did is you gave me, let's suppose any asset. Okay. Let's suppose you give me a pen. Okay. And this pen is the fair value of this pen is, let's suppose, 300. Now what is the amount of revenue that I should recognize? Tell me. How many for 400? 3. Okay. Can you please tell me the logic why 400? Okay. But I have given you the fair value of the pen as well, no? Why? Okay. I am telling you, if you can determine, then. No. Understand, always understand what you have received here. See, that concept which you are telling is applies in the case of asset, and that is the also logic. I will link both the case, don't worry. Okay, let's do it for both of us. When I am giving this calculator, it's an asset for you. You will apply Ind AS 116. When I'm selling this calculator, I will apply revenue Ind AS 115. Okay, let's analyze for both of us. I am saying my revenue will be 300. Why? Because this is what I have received. Consideration, what I have received. Okay. Now what you have received? Tell me. You have received 400, but what you have given up? So at what value you will recognize calculator in your books? 300. Don't you think it makes more sense? Right? You are recognizing an asset in your books worth 300, which becomes my consideration as well. Understanding the point? There should be consistency in the transaction, right? So basically, you are recognizing the asset at your cost. I am recognizing my revenue at my income. Right? Pardon? It is a goods. Then whatever we are receiving, that see what the whole logic here is, if you can determine the fair value, if you can determine, basically if me as an entity can determine the fair value of the asset that I am receiving, I will take that fair value. If I am not able to determine that, definitely I will take the fair value. Comes the logic here. See here. Please see this chart. Priority 1 is the fair value of the consideration that I am receiving. Fair value of the non-cash consideration that I am receiving. Okay. Priority number 2 is the fair value of the transferred goods or services. If I am unable to determine this one, then that comes a priority number 2, and that makes logic as well, right? Because see, in the first case you have received cash, so you are recognizing 300. So ideally in this case also you should say the fair value of the calculator is 400, so I should recognize ideally 400 as a revenue. No, since it was cash you told 300, but just because it's a pen you are saying no, we will not recognize that. No, it's not that case. So it should not make any difference between cash and non-cash consideration, unless otherwise, unless you cannot determine the fair value of this pen. Okay, if you can determine it, you will take this fair value. If you cannot, then you have to take this fair value. Is it clear, everyone? Don't do this mistake in the exam. Now, just please tell me. No, see here. Customer is also recording the asset at 300, no? But in market it's a goods. Here he is also not retailer, he is wholesale. So now whatever he is receiving asset, that fair value he need to return. Okay, now tell me, if you are giving me any particular goods for this calculator I've transferred, okay? Does it matter for me at what value you have recognized in your books? No, right? What matters for me? What I have received, right? What matters for me is what I have received. No, for why it will be high for the retailer? Okay, okay, understood your point. Understood your point. Now think of yourself. If this calculator is worth 400, you sold to a customer for 600. Will you recognize 400 as a revenue? How much will you recognize? Why cost will increase? Why your cost is 400? No, you do one thing. You place yourself in the place of a entity. Okay, make one of your friend as a customer and do this transaction. Then definitely will get a clarity on this one. Okay. If not, then after the class, sit with me. I will become the customer for you. Yes, please.
India 1638 we actually give priority fair value of assets given first priority.
Right.
But why in 195 first priority to assets?
Okay, understood. Very good question. But I have already explained this in the class, and I'll repeat it also. In India's 16, 38, and 40, you recognize the assets that you have received at what price? At your cost, right? At your cost. And what is the cost? The one that you give, whether cash or non-cash. Now, here when it comes to revenue, you recognize revenue at your income, right? What is your income? What you receive. Clear? See, whenever it's a barter transaction, don't get confused just because it's a barter transaction. See what was the logic initially that we understood. Apply this logic to barter, you will understand everything. PPE, we recognize that cost. That's we see what is my cost. Cash, non-cash doesn't matter. In revenue, we recognize that income. Whether cash, non-cash doesn't matter. Clear everyone now? Good. Coming to the next point, that is customer provided goods or services. Now, why will the customer provide goods or services to the entity? It can be possible. Let's suppose what happens in real estate contracts. I might give land to the entity for construction purposes, right? But when I give the land to the entity for construction purposes, does the control of the land transfer to the entity? No, the control is still with me. So will it impact the transaction price in any manner? No, right? Basically, when I as a customer give the land to the entity for construction, I'm just taking the construction services from him, right? And that is already discussed in the time of making the contract. So it says when the customer gives any goods or services to the entity for which the control doesn't get transferred, no treatment for that. But if the control gets transferred, you have to increase your transaction price for that. Meaning thereby what happens, let's suppose the customer gives this one goods or services to the entity. Okay, meaning thereby, see, think of it this way. This is entity, this is customer. Okay, entity has transferred the goods or services, right? Now entity will give consideration, right? Now entity is giving another goods or services, sorry, the customer is giving another goods services. If there is no control, definitely ignore. If there is a control, don't you think the customer is giving non-cash consideration to the entity, right? So what we'll do, we'll increase the transaction price with this amount, right? By the fair value of those goods or services. Clear everyone? But yes, understand again the same rule. If this fair value is not determinable, then we'll take the fair value of the goods or services and then adjust and record accordingly. Now, coming to the next point. Consideration payable to the customer. Now, I am paying, me as an entity is paying consideration to the customer. Understand, when the entity pays the consideration to customer and there are no distinct goods or services that the customer gives to the entity. Think of it this way. Entity, customer. Ideal situation, entity will give the goods or services and customer will give the consideration. Now, what is happening here is consideration is payable to customer. Entity is giving the consideration to the customer for which the customer is not giving any goods or services. Now, I will give you an example. You purchased a flight ticket from Paytm costing rupees 6,000. The Paytm gave you an instant discount or cashback of 1,000. What is your cost? 5,000. Me as a Paytm, what is my revenue? 5,000. I gave you an instant cashback of 1,000, right? So consideration, me, this is Paytm. So it collected 6,000, gave an instant cashback of 1,000. What is the consideration that I received? 5,000. So 5,000 will be my revenue, not 6,000. Clear everyone? Now, that's the reason it says reduce the consideration from the transaction price. Clear? Now, coming to distinct, meaning thereby, in this case, what happens? Customer also gives certain goods or services in relation for this consideration. Okay. Now, if the consideration which the entity is paying and the fair value of the distinct goods or services that the customer has given is same, no treatment, there's a separate transaction. Okay. Now, if the consideration is higher than the fair value, means sort of for a portion of the consideration there is no distinct good or services. For a portion of consideration there is no distinct good or services, right? Means you will reduce this one. consideration is lower than the fair value of distinct, means a portion of fair value of distinct goods or services that is received by the entity, there is no consideration, means there is this is sort of non-cash consideration, sort of a non-cash consideration. Add the excess fair value to the transaction price. Is that clear, everyone? This part is an area where a student generally tends to make mistake. Please make yourself comfortable with this concept. If it is not, then let me know. I'll explain other way around. Is it clear, everyone? This point. Mhm. Right. Mhm. Okay. Now see, understand. Basically, if they both of them are same, consideration of the and the fair value of distinct goods or services both are same, okay, we treat it as a separate transaction itself. Okay. But now if both of them are not same, means they are linked to this transaction, right? Then we cannot treat it as a separate transaction. What we will say is, if the consideration is more, why will someone pay me more consideration, right? So if the entity is paying the consideration, more consideration, then the fair value of the distinct goods that the entity has received, think of it this way. The goods that it has received is worth rupees 10, but I have paid consideration of 12. Means I have paid rupees 2 extra, right? Now don't you think that's like this one? That will be reduced from the transaction price. Why will I pay 2 rupees extra to the customer? I'm giving a benefit, right? So let's suppose here the consideration, in this case the consideration was, let's suppose 50. So what happens? 50 minus 2 will be my transaction price. 48 will be my transaction price. Now taking the another situation, here it is 15. The goods or services which I have given is worth 15, but the consideration which I have got is only 12. So 3 rupees goods that I have received is more, right? That's called a, so 3 is non-cash. 3 is non-cash, right? So my consideration would be 50 plus 3. Clear now? Now comes to step number 4. You want a break now? Okay, let's take a break of 15 minutes. Okay, let's start the class. Now see, we have studied 3 steps so far. Step 1, step 2, step 3. Step 1 being the contract, assume a contract exists. Now step 2 being the performance obligation, and step 3 being the transaction price. Now in step number 4, what we have to understand is, in step number 2 we identified there are 3 performance obligations. Step number 3 we identified for these 3 performance obligations what is the transaction price. Now in step number 4, what we are doing is we are breaking the transaction price to each of the performance obligations, okay, so that we are making this as a separate performance obligation, separate. So as and when this performance obligation gets satisfied, I will continue to recognize revenue for that. Okay, now so this is my intent behind step number 4, that is the allocation. Okay, now so standard says allocate the transaction price to each of the performance obligation in the ratio of the standalone selling price of each performance obligation. Standalone selling price of each performance obligation means what? Let's suppose I told that performance obligation number 1, performance obligation number 2, performance obligation number 3 exists, okay, and these 3 can be sold for rupee 30,000. This is like a combo pack, right? But now I have to assess, if I will sell performance obligation number 1 individually or standalone, at what price will I sell it off? Okay, so that's called standalone selling price. But many times what happens, the standalone selling price is not available. Might be the case that the entity doesn't sell it individually. Okay, now so if that is not available, what will you do in that case? You will take adjusted market assessment approach. What is the meaning of this one? Let's suppose the entity doesn't sell this calculator individually. So I will see if someone else in the market sells the similar calculator, might be for a different brand, then what I'll do, I'll adjust for the changes in the features or the brand name, whatever is the change. I will adjust the market value and arrive at the market price for this calculator which I am selling in this case. Okay, now this is called adjusted market price. Let's suppose in this situation, no one else in the market is also selling that product. So even I am not selling, so I don't have the standalone selling price. No one else in the market which I can identify is also selling, so I cannot find the adjusted market price also. But if I am selling, definitely I will know the cost, I will know the margin which I want from the customer, so I can take cost plus margin. And now cost plus profit is equals to what? Selling price only, no? Right? So cost plus margin I'll take. But now what happens in industries like software companies, like Infosys, when they make a software, they know the cost, but they might charge a margin of 10% to one customer, and they might charge a margin of 200% to another customer, depending upon the type of customer. So there is no specific margin for for them. Okay, so the range of margin is a very wide range, so the margin cannot be identified. So they say that if this is the possible case, then you take residual approach. Means you allocate the transaction price to the performance obligation which are allocable. If you are not able to identify the standalone selling price or the adjusted market price or the cost plus margin, then whatever remains will be allocated to that performance obligation. This is called as the priority 3. But yes, you have to understand that this will go in priority level. First is standalone selling price, second is adjusted market price, third is cost plus margin, and if it is not possible, then we'll come to residual approach. Is that clear, everyone? Now, this was very much easy, but now this is some exceptions. Let's understand these exceptions. Allocation of discount. Now, I'll give you examples. Forget this, what is written here. Just read this example and try to answer it. Example number 1. Please try to read this example and try to allocate the discount to A, B, and C. First, tell me what is the amount of discount. It is sold as a package for 100,000, that is 1 lakh. Individually, the price is 50, 25, and 45, 120. So discount is 20,000. Question is, how will you allocate to A, B, and C the discount? So the answer is again the same in the ratio of standalone selling price, that is the 50, 25, 45, right? Allocation you can show out. I'm not showing it off. Now coming to example number 2, it says, continuing with the above example, what if, read this question properly, what if entity X sells product B and C as a combo for 55,000? Means A plus B plus C is sold for 100,000. Now B plus C is sold for 55,000. Right? Now tell me what is the discount given in A plus B plus C? 20,000 is the amount of discount. What is the discount in B plus C? No, again assess. What is the price of B plus C? 25 plus 45 is 70. 70 B plus C, just a minute. B is 25 and C is 45. 25 plus 45. 25 plus 45 is 70. No, just a minute. Do one thing. 50 plus 25. Make it A and B, okay? Make it A and B. Change here. Make it A and B. A, okay? What is the price of A and B? 55,000. And what is the discount given in A plus B? 20,000. Discount is again 20,000 here. So what happens? Now see what is happening. If you sell A plus B plus C, discount is 20,000. If you sell A plus B, again the discount is 20,000. So what does it imply? C is not at a discount. Means this 20,000 discount you have to allocate to A and B only and not to C. Not to C. Now read this line. Generally, discount is allocated to all performance obligation in the ratio of the standalone selling price. However, if the discount is given for one or more goods or services and there is an observable market evidence for that, right? There is an observable market evidence. This is the observable market evidence. Right? Then we allocate the discount only to those goods and services and not to C. Will not allocate to C. Is it clear, everyone? Okay. Now, exceptions again. Variable consideration, allocation of variable consideration. It says that variable consideration may be attributable to all the performance obligation in the contract. Okay, it may be allocable to all the performance obligations, or only one or more but not all of the performance obligation, or one or more but not all distinct goods or services in a series of distinct goods or services. You know what is a series of distinct goods or services? When we provide the same services every day or for a period of time, that is called a series of distinct goods or services, right? But the whole series is one performance obligation, right? But in the series, I provide every day, I provide the same goods or services, and that is distinct. Okay. Now, so it says all distinct goods services, it is to be applied, or all performance obligation, or one or more. Okay. Now it says the example. A contract may include two performance obligation: the construction of the building and the provision of maintenance services, but a bonus variable consideration is payable only for the early completion of the construction services and not for the you can say provision for maintenance services. Okay, it's only for the construction and not for the maintenance. Is it clear, everyone? Basically, it's more like discount itself. It says that though variable consideration is there, but it can be allocated either to all or to only specific that will be given in the question. Okay. Like in our case, when we took that incentive, it was for the construction services. Now, step number 5. Recognize revenue as and when the PO gets satisfied, performance obligation gets satisfied. Now, tell me, when does PO get satisfied? When does PO get satisfied? When? Okay. Now, performance obligation. When does performance obligation get satisfied? When the control gets transferred. Very good. When the control of the goods or services are transferred to the customer. Okay. Now, we are saying that the performance obligation will be satisfied when the control is transferred. Now comes the question: what is the meaning of control? Right? Because see, to recognize the revenue, PO has to be satisfied. For PO to be satisfied, control has to be transferred. For identifying whether the control is transferred or not, we need to understand the meaning of control. Right? Let's understand the meaning of control. It says ability to direct the use or prevent others from directing the use. Let's suppose this calculator again. I own this calculator. I do have the control over this calculator. I can use this calculator in any manner I want to. Right? I can prevent others from using this calculator. Right? So that is one of the meaning of control. And if you link this with the lease that we studied yesterday, what was that? Right to direct the use means I can use it in any manner I want to for the period of over which I have taken it on lease. Right? Same thing. I have the ability to direct the use. What was the second condition for control? Right to receive substantially the economic benefit from use of the asset. But in lease I have got the use, but here I have got the ownership also, right? So I will receive substantially all the economic benefits. Can I say use? No. I will get from the use also, from the ownership also. Okay. When these two gets transferred, see there is a word called and. You have to write here and. When these two gets transferred, we say that the control is transferred. We say that the control is transferred. Now, what are the indicators? What are the indicators? The right to receive consideration is there for the entity. Okay. The legal title for a building or a property is transferred. The transfer of physical possession, the risk and rewards are transferred, or the customer has accepted the goods or services. It says that these are the indicators. If any one or multiple are satisfied, we can say, depending upon the case to case, we say the control is transferred. And when the control is transferred, we say the PO gets satisfied. When the PO is satisfied, we can recognize revenue for that. Is it clear, everyone? Now understand, when we say control gets transferred, the control can be transferred in two manner, either right now or over a period of time. Okay. Now, how will we analyze whether the control is transferring right now or over 2-year period or 3-year period or 4-year period? Okay. Now, standard gives us 3 conditions. It says if any one of them is satisfied, then we say that the control is transferred over a period. If none of them are transferred or satisfied, then we say it is at a point in time. See, if any of the above is satisfied, we say over a period of time. If no, then we say at a point in time. Is it clear, everyone? Okay. Now, what are the three conditions? Let's analyze it. Customer simultaneously receives and consumes the benefit as the entity performs. Entity's performance creates and enhances an asset that the customer controls. Entity does not have an alternative use of the asset and the entity has enforceable right to payment. Okay, let's take up an example. Let's suppose me as an entity and you are a customer, you enter into a contract with me for purchasing a flat. Okay, for purchasing a flat. Okay, I am constructing an apartment from which you want to purchase one of the flats. Now let's analyze these three conditions. Other than when I am performing, are you getting any benefit, receiving or consuming any benefit? Tell me. As and when I am constructing the apartment, are you receiving or consuming any benefit? No. Condition number 1 fails. Now, see, that's what is written here. Condition number 2, entity's performance creates and enhances an asset that the customer controls. As and when I am performing, it definitely creates an asset, but do you control that asset? No. So condition number 2 also fails. Condition number 3, entity doesn't have an alternative use of the asset. Till the time I have not transferred you the flat, don't you think I can use that building in any manner I want to? Right? And you can see also when the apartments are constructed, till the time it is under construction, it is used as a parking warehouse, right? It is used. So now, an entity has an enforceable right to payment for work done till date. Let's suppose if I have completed 40% of the work, can I say to the customer, no, give me 40% of the money now? I cannot say that. I cannot say that. The payment will be as per the payment terms, right? Not as per the enforceable right. Or if you have to see enforceable right, let's suppose you as a customer, you say that, sir, I want to cancel this contract. Now, can I say that, okay, if you want to cancel it off, but pay me the 40% money. Can I say that? No, right? Because you are cancelling this contract now. You cannot say that, okay? Because I can sell this flat to someone else in the market now. So none of the conditions are getting satisfied. So whenever I enter into a sale contract for a flat, it's always point in time, not over a period of time. Not over a period of time, okay? So sale of flats was revenue will be recognized at a point in time when I deliver the flat to the customer, when I hand over the flat to the customer. Now, another example. Let's suppose I do have a land of my own, okay? And okay, or let's suppose you are a customer and I am a entity, okay? You guys have a land of your own and you wanted me to construct a building over it, okay? Now you appointed me as a entity to construct a building over it. Now tell me, as and when I am constructing a building on the land given by you, can you receive and consume any benefit? No. Agree? As and when I am constructing a building on that land given by you, is that creating an asset? Yes. Do you control that asset? Yes. Land is yours. I am just constructing on that land for you. So you control that, right? So it is creating an asset for you that you control. So this condition gets satisfied. Now, if one of the condition gets satisfied, I will come to over a period of time. So now the revenue will be recognized over a period of time in that case. Is it clear, everyone? Now, see, when the control gets transferred at a specific point in time, when the control gets transferred at a specific point in time, I will recognize revenue at that point of time. But what if the control gets transferred over a period of time? I have to recognize the revenue over a period of time. But in how exactly? How much revenue to be recognized in year 1? How much in year 2? How much in year 3? How much in year 4? So I need a basis for that. How will I get the basis? Either input method or output method, right? So now, what is the meaning of input method? Efforts of the entity. What is the meaning of output method? Value to the customer. Let's suppose in our CA final FR classes, let's suppose we take around 250 hours classes, okay? I have completed around, let's suppose, 50 hour classes. Now, what is the efforts done by me? 1/5. So 20% efforts are done. So that is my efforts done. But now in that 20% in the exam, a question of 5 marks will only come. So what is the value driven to you? 5%. That 5% is the output, 20% is the input. Now it depends upon the company to company whether they want to go by input method or they want to go by the output method. Both the options are available. Okay, but you understood the meaning of what is the meaning of input and output method. Now the next point is contract modification. Tell me, I already told the meaning of modification in the last class. What is the meaning of modification? Or change in the estimates, terms. Okay, now if in the revenue contract the estimates changes, what will we do? And what is that method called as? I just took a name of it. Cumulative catch-up adjustment method, right? So when the estimates changes in this revenue chapter, we do cumulative catch-up adjustment. But when the contract changes, we account for it as a modification. And now I'll tell you this modification is exactly same as leases again. Tell me what was the three cases I discussed for in leases. First case was increase in scope with a change in the increase in the lease rentals, which is commensurate with the market rentals. If it is there, it's a separate contract. If it is not there, then I will go to case 3. Same is happening here. See, transaction price increase in scope. Transaction price of the increased scope represent the standalone price of the increased scope. If yes, separate contract. If no, go to case 3. Right? Exactly like leases. Now, it says contract modification, increase in scope or others. Modified performance obligation is distinct from the existing performance obligation. Means when the contract changes or the contract is modified, the performance obligation in the original contract is different from the performance obligation in the revised or the modified contract. Okay. Now, if that is the case, then you will treat it as a creation of a new contract or termination of an old contract. Okay. Now, basically, what you will do, whatever old contract was there, you will terminate that, and you will create a new contract. In this case, in this case, both the contracts will run parallelly. Okay, old contract will run as it is. The new contract which is happening here or the new modified terms will be treated as the new contract. Okay, so both the contracts will run parallelly. Here we will put a stop the old contract and we will start a new contract. Here both the contracts will run parallelly. But in this case, when this condition doesn't get satisfied, we treat it as a cumulative catch-up adjustment again. Is it clear? And I believe you already know the meaning of cumulative catch-up. Revenue to be recognized as per the revised estimates or the revised terms minus revenue already recognized. Very good. Okay, so this is again an example from a cumulative catch-up, and I've taken a detailed example, so this is not required, I believe, again. But yes, you can solve it in the home. Is everything clear so far from a 5-step model point of view? Now, can we just recapture all the 5 steps? Firstly, 5 minutes. Okay. Now, step 1 was contract. 5 conditions: approved, payment terms, rights and obligations, commercial substance. Then payment should be probably to be collected. If it is satisfied, move to step 2 to 5. Not satisfied, then I will reassess on every reporting dates. Okay. But if I have collected some advance, then I will assess 2 things. If the advance is substantial part of the transaction price, I have transferred all the goods and services, and the money that I have received is not refundable. Recognize it as a revenue, even if that's not a contract. Or if the advance that I have received, okay, that doesn't represent substantial part of the transaction price, but the contract is terminated and the amount is not refundable, recognize it as a revenue. Step number 1 over. Step number 2, determine the performance obligation. Assess what is the promises, and if the promises are distinct, they are performance obligation. Okay, if there are only one promise, that is a performance obligation. If there are multiple promises, we have to see which promises are distinct. If they are not distinct, we have to make a bundle and make a performance obligation. Clear? Now, moving on to step number 3, transaction price. Transaction price can be fixed, can be variable. If it is fixed, fine. If it is variable, we'll assess whether it can be included based on the current estimates or not. If it has to be included, we'll measure it using expected value, using most likely method. Now, after we have measured it, subsequently, if the estimates can change, but if the estimates changes, we'll use cumulative catch-up adjustment method. Very good. Now, after that, what was the significant financing component? In the significant financing component, we'll involve what? We'll take the revenue based on the value of the concession on the date when the control is transferred. On the date when the control is transferred, okay? we might have to recognize finance income or finance cost depending upon the scenario. Okay. Then we discussed non-cash consideration, for which we will give record fair value of the goods received as the revenue. If that is not available, I'll take fair value of the goods or services that I have transferred. Okay. Then I discussed consideration payable to the customer. Whenever I pay consideration to the customer for which I have not received any distinct goods or services, I will reduce from the transaction price. If the consideration that I pay is equal to the fair value of the distinct goods or services, no treatment, right? And there are two other cases, like consideration paid is greater than the fair value that goods that I have received, means I have paid the consideration to the customer higher. This I will reduce from the transaction price. If the fair value is higher, then I will treat it as a non-cash consideration. Okay. If I have received goods or services from the customer, okay, and I have not got the control of that, ignore that. If I have got the control of that, then add to the transaction price, treat it as a non-cash consideration. Clear, everyone? Now coming to step number 4 is allocation. Ideally we'll do in the basis of standalone selling price. If that is not available, then adjusted market price or cost plus margin or residual approach. Allocation of discount generally to all in the ratio of standalone selling price, but if the discount is allocable to a specific performance obligation and there is an observable market evidence for that, we'll allocate to those performance obligations. Then step 4. Step 5 is recognize revenue as and when the PO gets satisfied. Now, when does PO get satisfied? When the control is transferred, right? Now the control can get transferred within two manners. One is either point in time or over a period of time. Now, how to assess that? There are three conditions for that. If any one of them is satisfied, over time. If none of them is satisfied, point in time. Three conditions are: customer simultaneously receives and consumes the benefit as the entity performs. Entity's performance creates and enhances an asset that the customer controls. The third one is enforceable right and no alternative use, right? So all the 5 steps are clear now. Good. Coming on to the specific business models, special business models. Now, okay, all of us have to some other time book flight tickets, right? Now when we book the flight tickets, we can book it through Indigo, Make My Trip or Paytm might be the case, right? But now tell me, who has the responsibility of fulfilling the contract? Make My Trip or Indigo? Indigo has the responsibility, right? Now, you pay the whole amount to Make My Trip or Indigo, Make My Trip, right? Not to Indigo. You don't have any connection with Indigo directly. You have the connection with the Make My Trip. Let's suppose you paid 6,000 to Make My Trip. Okay, Make My Trip charges a commission of 500 and transfers 5,500 to Indigo. The question is, what is the amount of revenue that Make My Trip should recognize? 500 or 6,000? I'm giving you two options. Don't see here in the screen, okay? Option number 1 and option number 2. Answer according to yourself. Option 1, option number 2. Option 1 is revenue is 500. Option number 1 is revenue is 600 and the cost is 5,500. The profitability will be the same in both the cases. Option 1. Why? Because is my ordinary course of activities to provide the flight services? No. Is to just give an aggregator services, right? So I will record this revenue. So always remember the Make My Trip or the Paytm, they are the agents, right? And agents recognize net revenue and the principal recognizes gross revenue. So principal will recognize that Indigo will recognize 6,000 as the revenue and 500 as the commission expense. This is very much clear to everyone. But in the exam, they will not ask this also. In the exam, they will ask you to analyze whether the party, which party is principal and which party is an agent. Okay? Because this accounting can be done by anyone. What will make you different as a chartered accountant will be analysis of which party is the principal and which party is the agent. Now, standard says that 3 indicators standard gives, okay? Standard says based on this you have to analyze whether you are a principal or you are an agent, okay? The conditions are: who establishes the price? Tell me in this case, who will establish the price of the flight ticket? Indigo. Who bears the inventory risk? Let's suppose there are 180 seats in a flight and only 150 seats are filled, 30 seats are remaining. Who will bear the loss? Indigo. Who has the primary responsibility of fulfilling the contract? Indigo. So its standard says these are the three indicators which you have to analyze on a case to case basis and then conclude that who is the principal and who is the agent. Understood now? The indicators I have written here though. Let's read this question and try to answer. Just I want an answer who is an agent and who is a principal. So what does the question say? An entity negotiates with the major airlines to purchase flight tickets at reduced rates compared with the price of the tickets sold by the airlines to the public. Okay, now what I'll do is I'll write here. This is airlines. This is the entity under assessment now. Okay. Now what does the entity negotiates with the airlines to purchase tickets at a reduced rates compared with the price of the tickets sold directly with the airlines to the public. Okay. Now let's suppose it might be the case, this is public. It purchases at 6,000, but it wants to purchase at 5,500. Okay. Now entity agrees to sell a specific number of tickets and will pay for those tickets even if it is not able to resell them. Now what entity says is, I will purchase, let's suppose 50 tickets. Okay. Now entity also says that even if I'm unable to sell it, even if I'm unable to sell it, I will bear the loss. Now tell me who bears the inventory risk? Now, if he bears the inventory risk and he have purchased the flight tickets, okay, let's suppose you have purchased 50 flight tickets, okay, from the Indigo. Now, don't you think now you have the discretion to sell at what price you want to? Now, who is establishing the price? You, right? So, price establishment power comes to the entity. Now, the reduced rate paid by the entity for each ticket purchased is negotiated and agreed in advance. The entity determines the prices. See, the entity determines the prices at which the airline tickets will be sold to the customers. So, who establishes the price? The entity. Entity sells the tickets and collects the consideration from the customers when the tickets are sold, and therefore no credit risk to the entity. The entity also assists the customers in resolving the complaints with the customers with the service provided by the airlines. However, each airline is responsible for fulfilling the obligations. Now it says the responsibility for fulfilling the contract is with the airlines. Is with airlines. Okay. Now, determine whether the entity is a principal or an agent with suitable explanation in line with the provisions of the given in the standard. Now it says, see, inventory risk you have, price establishment right you have, right? Definitely for the whole of the flight, the responsibility for reaching a customer from point A to point B, that responsibility even if I don't have, but I am the owner of the flight tickets, right? So what I will do in this case, I will record gross revenue, and the entity will become the principal in this case. Entity will become the principal in this case only for the to the extent of flight tickets, not for the delivering the services to the customer. Okay. So what will entity do? Entity will recognize a revenue of 6,000 and a cost of 5500 and record a profit of 500 in this case. So as I have said, the answers will change from case to case. Okay. Now these parties like Amazon, Flipkart, all these parties, you see they record at a you can say at a net revenue, but there are instances that they record at gross revenue also. Okay, because they have opened up their entities also now. Okay. So this is the case. Is it clear, everyone, so far? Now come. Pardon? Pardon? No, there is no credit to airlines because the amount is paid clearly, right? Therefore, no. See, read this question, read this part. Now understand, the entity determines the prices at which the airline tickets will be sold to the customers. It says the entity will determine that the price which will be sold. Okay, the entity says the tickets and collects the consideration from the customers. Therefore, there is no credit risk to the entity. Okay, means if I am an entity, I will sell to the customers. I will determine the price at which I will sell, and I will collect the consideration, and there is no credit risk to the entity. And now, if you talk about the credit risk to the airlines, still there is no credit risk. Why? Because the entity has already paid the amount to the airlines. See, this is also written here. The reduced rate paid by the entity for each purchase ticket is negotiated and agreed in advance. So that's already agreed in advance. There is no change in that. Okay. Now, coming to pardon. No, indicators cannot be cumulative at any given point of time, right? Indicators are your. No, as I told, it has to be assessed on a case-to-case basis. It can be the case that two conditions are satisfied, but still we are classifying it as an agent. Okay, but it has to be determined on a case-to-case basis. Who bears the, yes, it's judgment based. It's judgment based. I'll say the whole standard of revenue is judgment based. Okay, but yes, from an exam perspective, they will give some other line clearly, which if you can identify that line, it will state that you are a principal or you're an agent. It will be clearly mentioned. In this question, this is the line. Sorry, take red pen. This is the line, right? Now, clear? Can we move it? Okay. Upfront refundable fees. We go to the gym and pay joining fees. That's different. That we don't go subsequently. Okay. Okay. Now we pay joining fees. One-time joining fees we pay for 12 months, but we don't go after 10 days. Okay. Now the question is, the joining fees that we pay to the gym, can we recognize it as a revenue? So standard says, ask a question. Does this fee relate to a specific good or services transferred to the customer? Now let's suppose when you pay the joining fees, it might be the case that the gym gives you a joining goodie, okay, a goodie bag, which will have all the you can say the gym equipments, or might be some other stuffs. Okay. Now if that is the case, then recognize the revenue upfrontly. If that is not the case, then recognize the revenue over the period. Okay. So see, it says if there are specific goods or services, then recognize revenue for the transferring the promised goods or services. But if no, then recognize as a deposit liability when you receive the amount, and recognize as a revenue over the period of time. Clear, everyone? This concept is very good. Sale with a right to return. Let's understand this one. Amazon sold. When you purchase anything from Amazon, you see 30 days return policy is there, right? Or Flipkart, or might be from any e-commerce websites, there is a 30 days return policy. Now, if I have sold the goods now and there is a 30 days return policy, how do you think Amazon or Flipkart or Myntra, for that matter, will recognize revenue? And then we recognize revenue, right? As of now, I am receiving the money, don't recognize revenue. Wait till 30 days. After 30 days, if the customer returns the goods, don't recognize revenue. If the customer doesn't return the goods, recognize revenue. No, that doesn't happen. Pardon?
They will create provisions for the chances of return. They have got some input like 100, there will be 10 or 12 which will come back. So they will create a provision for 10 as well, recognize for all 100. And after the time is over, if the provision, they will change the provision.
Okay, correct to some extent, but not exactly. They'll not recognize a provision in this case. So what happens? Definitely see Amazon has past history. They know ideally how much percentage goods comes as a return. Okay. First of all, you have to assess if the sale is happening during the year. This does not have any impact only, right? This doesn't have any impact only. I sold the goods now. I will, if you say provision, though we don't record a provision, even if you record a provision, okay, within 30 days I'll get to know whether it will be sold or not sold, right? So I will reverse the provision if I go according to you. According to me, what should be done is I will record revenue, but I will not record the revenue for the extent I believe the goods will be returned. Okay, let's suppose I have sold 100 laptops and I think that 5% of the goods are returned on an ideal basis. So what I'll do is I'll record the revenue only for the 95 laptops and not for the 5 laptops. Okay. During the year, if this transaction is happening, if I record revenue for 95 or for 100, doesn't matter. Why? Because within 30 days, anyways, I will get to know and I'll record the revenue accordingly. The impact of this sale of right to return is actually happening within the last 30 days of the year end, right? So what happens then? Let's understand. I need space, I'll take it here. March. Okay, let's suppose this is 10th March. I have sold 100 laptops at a price of, what is the price? 50,000. Okay, the cost of which is 40,000. Now I expect that 5% will be returned. Now comes the question, how will I recognize the revenue? So definitely in the bank, I will record how much? Tell me. 50,000 multiplied by 100 is how much? 50 lakhs. Right now, question is, will I record 50 lakh as a revenue? No. I will record revenue to the extent of only 95%. So I will record 50 lakh multiplied by 95%. What will all the rest 5%? I will record it as a refund liability as of now. It will be 50 lakh multiplied by 5%. That calculation you can do it off. But now applying matching concept, can I recognize the cost to the extent of 100%? Cost of goods sold? No. If I have recognized revenue to the 95%, I can recognize cost also to the 95%. But my inventory has gone fully. What I'll do? Definitely I will say to inventory 40 lakhs, right? But cost of sales will be how much? 40 lakhs multiplied by 95%. What about the rest 5%? I will record that as a right to return asset. See, ideally you can say this name right to return asset is just a name. You can write it as an inventory also, but we don't prefer writing it as an inventory because it will just create confusion for the entity. Inventory, actually we record only which is lying with us. You can say inventory lying with a customer, you can say inventory lying with a third party. You can give any name, okay? The standard gives a name of right to return asset. You can follow this also, okay? But yes, even if you write inventory lying with a customer, no marks will be deducted for that, okay? So this will be 40 lakhs multiplied by 5% is what we have done. Now 30 days was the return policy, right? It gets over on 9th of April. Okay. Now 9th of April, I'll write here 30 days return policy. There can be multiple things happening here. Goods are returned. Goods are returned. Okay. Now, so what I'll do, let's suppose 2 returned and 3 not returned. Okay, let's take it this way. For 2 that is returned, what I'll do? Refund liability account debit to bank. For the 3 which is not returned, I'll do refund liability debit to revenue. Okay. What is the amount? Can you please tell me? 50,000 into 2 is 1 lakh. 50,000 into 3 is 1.5 lakh. Okay. Now, for what I'll do here is right to return. Sorry, I will record here inventory, because I have received the goods back, so it will increase my inventory to right to return asset. So 40,000 was the price of 1 into 2 is 0.8 lakhs, and again cost of sales account debit to right to return asset 1.2 lakhs. So this is how the right to return asset accounting will be done. Is that clear, everyone? Okay. Now, crux. Understand? Read this one. This is exactly the what I have written there. Recognize revenue to the extent it will not be reversed. To the extent it will not be reversed. That is, do not recognize the revenue for the expected returns. Recognize the cost of sales only to the extent revenue is recognized. For inventory not recognized as cost of sales, recognize right to return asset. On expiry of the return period, if the goods are not returned, then reverse refund liability and recognize revenue. If the goods are returned, then pay off refund liability. Clear, everyone? Please confirm if I can move ahead to the next topic. Clear, everyone? Now the next one is warranty. We studied warranty some time back also, right? Now warranty are of 2 types. One is standard warranty or an inbuilt warranty. One is extended warranty. Extended warranty was a separate performance obligation we studied, right? Now if it is separate performance obligation, we'll move on to step 1 to 5 and recognize revenue for that. But for inbuilt warranty, is it a separate performance obligation? No. Will I receive any separate revenue from the customer for that? No. But definitely I'll incur cost for that, right? And I do have an obligation to incur the cost, right? Now, if I do have an obligation which I cannot avoid, which will be settled in the future, the amount of which is not certain for me, what is it called as? What is it called as? Provision. So what will happen? See, warranties are a part of the product that is not a distinct good or services, not a distinct good or services. Example, you can write here inbuilt warranty. Example, you can write here inbuilt warranty. Okay, not a separate performance obligation. Hence, we have to create a provision under Ind AS 37. Now, if it is a distinct good or services, then it is a separate performance obligation which is called as standard, or you can, sorry, not standard, extended warranty. Okay, now this is a separate performance obligation for which we will recognize revenue over the warranty period. Is it clear, everyone? Now coming to consignment arrangement. In a consignment arrangement, there are 3 parties: consignor, consignee, and the end customer. What happens? What is the arrangement of consignor is? See, let's suppose consignor is, let's suppose I have 50 copies of this book. I gave it to the one party, just sell these books. Okay. Now, when I'm giving these books to the consignee, am I transferring the control? No. Why? Because at the end of the day, the books which remain unsold will be returned back to me, right? But when the consignee sells those books to the end customer, it is then that the control gets transferred, right? So the question is, at what point of time will I recognize the revenue? When I transfer the goods to the consignee? No, because the control doesn't get transferred. But when the consignee transfers the goods to the end customer, the control gets transferred, and it is then I will have to recognize revenue. Now, just a simple logic. Tell me, consignee will recognize gross revenue or net revenue? Because if I am giving to the consignee to sell these books, I will give something to him also, right? A commission, right? So he will recognize net revenue because he will act as an agent, right? And he will recognize gross revenue. Is it clear? He will act as a principal. He will act as an agent. Clear, everyone? Revenue is recognized when the control gets transferred. Control is transferred when the goods or services are transferred from consignee to end customer. Is it clear, everyone? Now, if you purchase anything from the shopping mall, like you will get loyalty points, right? Or you get discount coupons, right? That which you can avail in the next purchase. They give you coupons, sir. This is the 500 rupees coupon which you can avail in the next purchase. They give, right? How do the accounting for that happen? How to account for those? Standard says that whenever the entity gives the loyalty points or the discount vouchers to the customer, which can be redeemed in the next purchase, treat it as a separate performance obligation. Okay, treat it as a separate performance obligation. But only one condition is there. Only one condition is there. Condition. And the condition is that should provide a material right to the customer. Let me give you an example. When I was purchasing a shirt, okay, from a shopping mall, so they give me a discount coupon, or they told that that was a sale time, okay, in December. Everywhere there was a sale of 10%. I went to purchase a shirt, I got a discount of 10%. Okay, is that a material right? No, everyone is getting that. Okay, but when after I purchase the shirt, they give me a discount coupon of 500. Okay, they told that, sir, since you have purchased this shirt, I'm giving you a discount coupon of 500, which you can avail in the next purchase. Now, is it given to everyone? No, it is given to me, the one who purchases it, right? So this gives me material right. Okay, now what is the valuation of material right is what we have to determine. Let's suppose for everyone 10% discount was there. Okay, now I got a discount voucher in which it was written I can avail a discount of 40%. I can avail a discount of 40%, but there was one condition. If you avail this discount of 40%, you cannot avail the discount of 10%. Okay, now ideally 10%, so I can get easily also, right? So what is my right, material right that I'm getting? The 30%, not the 40%, not the 40%. Okay, so due to entering into this contract, I'm getting 30% extra discount. So this 30% is the material right. Okay, now discount that a customer would not receive without entering into the contract. Example. This example is very much easy. You can read this example just. Then I'll discuss the accounting treatment. Flat discount of 20%, no material right, right? Shop for INR 3000 or more and flat discount of 20% on the next purchase. Discount of 20% gives a material right to the customer. These two are separate. Okay, these two are separate. Don't think this one. If you merge these two, this 20% is not material right, right? Because 20 minus 20 will become 0%. Okay, these two are separate, not one. Understood? Now, accounting treatment. Shall I take a question and discuss the accounting treatment rather than discussing directly the accounting treatment? This question was asked in latest attempt, November 2022, for 4 marks. Question number 2C. Now, did you solve past paper? Latest past paper? Anyone solved? Okay. No worries. It's too early to solve, huh? An entity enters into a contract for sale of a product A for rupees 1000. Okay, this is an entity sold goods to the customer for rupees 1000. Okay, as part of the contract, the entity gives a discount. Gives the customer a discount of 40% on any future purchases up to 4000. Up to INR 1000. Okay, now in the next 30 days, the entity intends to offer a 10% discount on all sales. Now 10% discount to everyone. What is the material right? Now the material right is 30%. Okay, now as it says that the 10% discount cannot be used in addition to the 40% discount. If I will change the question a little bit, I say can be used, then what is the material right? 40%. Very good. The entity believes. Now tell me, if you get a discount coupon, how many times do you think you have went to the stock again to the mall and availed the discount? Because personally I never went. Okay, because we get the discount coupons, we forget where we have kept it off, right? So entity believes that 80% likelihood that the customer will redeem the voucher. 80% is still too high. Okay, in my case it can be 0%. On an average, okay, a customer will purchase 500 of the additional goods. Now tell me, understand, you have given him a discount coupon of 40%, okay, out of which 30% is the material right. It says customer will purchase goods worth rupees 500. So what is the discount that will be given to him? 30%. You will give material discount, right? And what is the chance that the customer will avail the discount? 80%. So what is the value? 120. Now understand. Okay. Now this is performance obligation number 2. So now what is the performance obligation number 1? What is performance obligation number 2? Performance obligation number 1 means sale of goods. Sale of goods. The standalone selling price of which was 1000. This is loyalty points. The standalone selling price of which is 120. So total standalone selling price is 1120. But it is sold at what price? 1000. So we have to allocate the discount. We have to allocate this loyalty points. Now this transaction price of 1000 to this, sorry. Yeah. Now how will we do that? It is 1000 multiplied by 1000 divided by 1120. Now it is 1000 multiplied by 120 divided by 1120. Can you please tell me what is the amount? 890 and 110, right? Now what will you do? You have received the whole 1000 now itself. Bank account debit to revenue, how much? 890, to refund liability 110, revenue is 1000. Meaning thereby refund liability 110 means what? In the next purchase I will not charge this amount to the customer, but when the customer purchases it next time, I will recognize 110 as revenue. Clear now? Now let's read this point. Allocate the transaction price of the product to product and the discount voucher or loyalty points. Okay, whatever is the discount, whatever is the price. Let's suppose I purchased this shirt for 2000. You have to allocate this 2000 to the shirt and to the loyalty points. Okay, whatever is the amount allocated to the shirt, recognize it as a revenue now. Whatever is the amount allocated to the loyalty points, park it for some time and record as a refund liability when you deliver the goods to customer in the future. Okay, so it's like you have already collected the amount but not given the services or provided the goods to the customer. When you actually do it in the future, record the revenue in that case. Okay, now how to calculate standalone selling price of the discount voucher? Expected future purchase, effective discount, material right 30%, probability is 80%. Clear? Now, so this is how you will allocate the discount. Is it clear, everyone? Clear, everyone? Any queries? No. Now comes bill and hold arrangements. Many a times what we do is when we go for a shopping, we purchase something from one shop, okay, but we have to go to another shop also now. What we'll do, we don't want to carry the whole load to all the shops, right? So what we do is we purchased, we billed, we paid the money, keep it separately, I'll come and collect it off, right? So that's what is called bill and hold. Now standard says that this arrangement will hold good only when the customer has requested the arrangement. Okay, the product must be identified as separately belonging to the customer. Okay, entity cannot sell the goods. Okay, and the product is ready for the transfer. If all these conditions get satisfied, standard says that bill is a separate performance obligation which you have already satisfied and received the money. Hold is also one of the performance obligation. You are giving the services of holding your goods to your customer. You are giving a service of warehousing to your customer. Okay, so basically that's a separate performance obligation which you have to allocate the transaction price and then recognize the revenue for that. Is it clear, everyone? Now, repurchase agreements, a very simple concept. Many a times what happens, we sell the goods to the customer but with a right to repurchase. Now there can be two possible instances. I have sold the goods to the customer for rupees 100 and told to the customer that you cannot use the product. Okay, and I have a right to repurchase the goods after 2 years at 121. Think of it this way: entity, customer, sold the goods, received 100. Clear till here? Right to repurchase at 121 after 2 years, and the customer cannot use. Tell me, when we take a loan from the bank and we give our home as a mortgage, does the bank uses the home? No, right? Now, we take, let's suppose 1 lakh rupees as a loan. What is the amount that we repay to the bank? Higher amount. Now, entity is collecting 100 now, paying 121 after 2 years, right? And the customer cannot use the product. So don't you think it's like a financing arrangement? See here. Repurchase price, that is 121, is higher than the original price, that is 100, and the customer cannot use the goods or services. Again, if the customer cannot use the goods or services, can we say that the control of the goods or services is transferred to the customer? No. Control not transferred. Was it a sale transaction? No, it was not a sale transaction itself. If it is not a sale transaction, I have received the money 100, paid 121. Is it? It is a what? It is a financing arrangement. It is a financing transaction under Ind AS 109. Now I will change the situation again. I received 100, but right to repurchase at 82 after 2 years, and the customer can use the product. Now what is happening? I received 100, and after 2 years I am paying 82, means I received 18. And what customer got? Customer got the right to use for 2 years. What is it called as? Lease. See, repurchase price is 82, original selling price was 100, means entity got 18 rupees and the customer got the right to use the goods. It is a lease transaction. Clear, everyone? Now, the same arrangement can be given in the question, can come in the exam as a question. Just they will change the names. They will say, if there is a call or put option. What is the meaning of call? Right to purchase or right to sell, right? Put means right to sell, call means right to purchase. Attached to that goods or services, then on the date of sale, any amount which you received will be recorded as a liability. Okay. Now, on the settlement date, if the call or put lapses, recognize revenue. If it gets exercised, you transfer the goods and receive the money. Is it clear, everyone? So it can be a financing or lease arrangement. It is just this transaction itself, but said in other manner. Okay. In the exam, question can come in this form as well. Is it clear, everyone, so far? Now, sales or usage based royalty. Let's suppose this book okay. Some of the publisher comes to me and says that, sir, give the right to sell this book. I told, okay, fine. What I will get for that? So for each book which I'll sell, I will give you 50 rupees. Okay. Now tell me, do I know how many books they will sell? Do I know what is the amount that I'm going to get in the future? Can I recognize the revenue now? Because I have given the rights now itself. The right is transferred now, but I will receive the concession in the future. So you will say, sir, there is a timing gap between the transfer of goods and receiving the consideration. There is a significant financing component involved. No. Now come again to significant financing component. That was an exception there, if you can recall it. Read this line, second point. Consideration is variable and the amount of timing depends on the future event, right? So this sales or usage based royalty, you will say this is not a significant financing component. The reason is I don't know what is going to happen in the future. How many books will be going to sell, right? So the consideration, though there is a timing gap between transfer of goods and receiving the consideration, but still it is not a significant financing component. And I will recognize the revenue on an actual basis. So it says revenue is recognized when subsequent sale occurs or the performance obligation to which the sales based royalty has been allocated is satisfied. Okay, so whatever comes later, I will recognize the revenue accordingly. Okay, now service concession arrangements. Okay, but before we go to this one, tell me, any queries so far? Anyone having any queries? No? Okay. Service concession arrangements. Do you know, guys, what is the meaning of service concession arrangements? What is the meaning? Do you know what is public-private partnership? What it is? No. Do you know what is build, operate, transfer model, BOT model? They'll take collect in the form of toll or after certain number of years, they'll give it back to the country. Exactly. Okay, so there are multiple countries in the world who have developed their infrastructure using this model. Okay, now and India is also adopting this model now. Okay, now all the airports which you see, they have been built by the private players. Okay, like GMR, like Adani, right? Now what happens in this one? The government doesn't have sufficient funds. Like it's not like Middle East, right? Where the government has sufficient funds. In India, the government doesn't have sufficient funds, but they want to build the infrastructure. So what they want is they engage or they enter into partnership with the private players. Okay, and they say, please build this infrastructure for me. Now the private player will definitely see their profit. What will I get? So they get the right to collect the revenue from them. See, if they have constructed a road, they will get the right to collect the toll. If they have constructed an airport, they will collect to sponsorships of the advertisements. In any airport which you go, you will see n number of advertisements. Why? They are getting the money for that, right? So there is a right to receive that. Okay, that's what is called public-private partnership. Okay, or it is also called as a build, operate, transfer model. Okay, wherein let's suppose a company like L&T enters into a contract with a National Highways Authority of India, that is NHAI, to construct the road. Okay, now what happens? Infrastructure will be owned by the government. It will not be owned by the private player. Okay, it will not be owned by the private player. Okay, and hence cannot be recognized by PPE as an entity. One student asked me in the last batch that, sir, this is built by me. How can government own it? Tell me, do you control that? No. Can I? Even if Adani has built a airport, can Adani say I control this airport? No, that is controlled by the government of India. Right now. So how will the accounting happen for that in that manner? So definitely when the entity incurs the expenses, okay, so what they will do is definitely they will start recognizing it as a financial asset or an intangible asset. Okay, now all the expenses incurred, so what they will do, they will see. Now there can be two possible instances. Either the government will say, I will give you a contractual right to receive this much cash flows every year. Okay, sufficient, like you can say this one, fixed amount of cash from the government every year you will get, or the government will give you a right to collect the toll from the general public. These can be the two possible instances. Now if you are getting the right to receive fixed amount of cash, don't you think it is a financial asset? What is the meaning of financial asset? Contractual right to receive the fixed amount of cash, right, in the future. Now, So this is a financial asset. I will record as a financial asset, which I will record as a construction revenue. Now, if it is a right to collect toll, do I know what is the amount of toll that I'll collect? No. So it becomes an intangible asset for me. Okay. So I will record an intangible asset, and again a corresponding I will record a revenue. Now, from this financial asset, definitely I unwind and record finance income. From intangible assets, I will record the future economic benefits I will receive as a revenue. Is that clear, everyone? Now, subsequently recognize finance income and realize the contractual cash flows from the government. And for this toll, amortize intangible asset over the period in which the entity has a right to collect the toll and collect toll and record as a revenue. Clear, everyone? Now, contract costs. Understand, guys, whenever a contract is being, whenever we enter into any contract, we might have to incur the cost at two stages. One, at the time when the contract is being pitched, okay, when we are pitching a contract, okay. Another, at the time when the contract is being executed. So let's assess for both the situations. When we are pitching for a contract, or when we are negotiating for a contract, whether I'll get a contract or not, I might incur certain costs, and those costs can again be of two types. One, if I will incur those costs only and only if the contract is finalized. Another cost, it will be incurred irrespective of whether the contract is finalized or not. The standard says if it would be incurred irrespective of whether the contract is finalized or not, transfer to P&L. But if it is like it will be incurred only if the contract is finalized, then recognize it as an asset and amortize over the contract term. Okay. Now, contract fulfillment cost means it contract cost incurred at the time of execution of the contract. Okay. So generally standard says that generally it will be covered in the separate standard. Okay. Now, if it is covered in the separate standard, we have to account for as per the separate standard. If for a particular cost, no specific standard governs that, I will record as an asset and amortize over the contract term. So this is how I will record the contract costs. So only logic is if that is specifically for this contract, record as asset and amortize over contract term. If it is to be incurred irrespective of whether the contract is finalized or not, record in the P&L. Execution costs as per the other standards or otherwise record as an asset and amortize over the contract term. Is that clear, everyone? Wonderful. So that completes our standard on revenue. Anyone having any queries in the overall revenue standard? No one? Yes, please. Pardon? Yes. Yes.
If there are if full toll is issued, some part will be going to government, some part will be going to the company. Then how will be the account? Like how much we should?
See, we have to recognize the intangible asset itself at that right. So let's suppose it says the toll will be received, 50% toll will go to the private player and 50% toll will go to the government, and that happens practically as well. Okay, so we will recognize the intangible asset on the basis of that right. Okay, so intangible asset is what? Intangible asset is nothing but it represents the toll that I am going to collect in the future. My right to collect the toll. If I have the right to collect 50% toll over 5 years, I will recognize the intangible asset accordingly. Okay. Any other query, guys?